And that, I think, is what's creating a really unstable situation.
I think there were lots of clearing of Gazas in other times and other places. A singular distinction here, and particularly to, worries about an Arab Spring and maybe the separation of societies in the Arab nations, is the video it's just shocking, John. The horrific Twitter videos I slipped by, they were in my feed and I went by. And I don't, this goes back to a guy named Marshall McLuhan, folks, in the fistfights around my parents' dining room table about the media. We're having that right now. And the whole media presentation here worldwide is front and center.
We're trying to keep up the speed, Tom, just witnessing really intense diplomacy over the last week or so. President Biden and German Chancellor Olaf Scholz weighing trips to Israel. Biden pushing to provide aid to both Ukraine and Israel. In an interview with 60 Minutes, the president's saying this. This is a key quote. "We have the capacity to do this, and we have an obligation to. And if we don't, who does?" Lisa, that's a question we're asking in the bond market. Do they have the capacity to deal with this?
Especially given the fact that there have been calls to cut borrowing costs and actually reluctance to fund the war in Ukraine, and now you add into this. That said, as you referenced, it was a CNN poll, a Washington Post poll came out with similar types of results. The overwhelming support in the United States is to support Israel and to continue to fund any kind of defense. You also saw 2 warships being placed in that vicinity to prevent Iran and more particularly Hezbollah from going into Israel. Where are the red lines? This is what I don't think we understand as they come and we see all of these frantic diplomacy talks.
Should we talk about a lighter story?
Please.
Let's finish on this. Shares of Manchester United falling in the pre-market by more than 10% after Qatari investors withdrew their bid for the team. British billionaire Jim Ratcliffe may end up with an initial stake of roughly 25% in the club, valuing the team at more than $6.1 billion. So the stock is lower, Tom, because ultimately what a lot of investors wanted to see was a full takeover by the Qataris at a very inflated price. And it looks like, based on what we're hearing over the weekend, that's not going to happen.
What's the history of success of a set of owners' clubs? I mean, the Yankees are a set of owners, but the Steinbrenners ran it. Newcastle, I perceive, is one owner. I don't know if that's true or not. That's the way I perceive it, at least, and that's been a big success. But can teams run with a set of owners in the English Premier League?
Let me put it this way. Has Liverpool had a lot of success under John Henry? I'd say they have. They've done pretty well, haven't they?
Yeah,
Not distracted by what's happening.
They frankly should have beat the Tots, but that's a different
over at the Red
story.
Sox. Arsenal having some success as well. More recently, Stan Kroenke.
And they have multiple owners?
So Stan Kroenke's got multiple teams, hasn't he?
Yeah.
Across multiple things, if that's the direction we're going in.
What's it mean for Luton?
What's it mean for Luton? I've got no idea what it means for Luton, Tom. What it means for Premier League
So what's the
football.
value of Man U right now, a wise one?
Based on that investment, north of $6 billion. North of 6. I'm not sure how much the Glazers wanted for this football team, but apparently the Qataris walking away, withdrawing the bid.
We'll continue to discuss this topic with surveillance English Premier League expert John Farrow. On the equity markets now, Liz Ann Saunders, Chief Investment Strategist at Charles Schwab. Liz Ann, from the peakish of early 2022, I've got SPX in a corrective state, down roughly 10%. I'll let you decide. Are we in a bear market or are we in a bull market?
You know, it's funny when you think about bear markets and lots of analysis of 1 year off the low and how that compares to past eras. But even the big, ugly bear markets like 2000 to 2002 and 07 to 09 had multiple cycles within them, to the extent you're using the simple definition of up 20% as a bull, down 20% as a bear. And I agree that there probably makes sense to have more nuanced definitions. But with that simplicity, you had multiple moves. So it's just too soon to say whether we're truly out of the woods. It doesn't look like a typical major market low, given fairly anemic performance by the S&P, no participation by the banks at all, minuscule participation by small caps. So there's a lot of check marks against the market, not to mention that only 2% of the S&P right now is trading at a 1 year high. So there's a lot of checks against the market at this point. That doesn't necessarily mean the market has to retest last year's lows.
Cut to the chase. I mean, you're way too young to remember Nifty 50 like I am, but do you go to the Saunders Nifty 10 or the Nifty 20, or do you actually index?
It's hard to outperform without the Magnificent Seven. They represent just about 30% of the index right now. That's relative to less than 20% in earnings weight. So I think earnings season is going to be key to see whether maybe we narrow that gap between the cap weight and the earnings weight. That said, having a small handful of stocks dominate performance in a cap-weighted index like the S&P or the NASDAQ is not uncommon. It's when you have the rest of the index so dramatically underperforming, whether you look at it on a percentage of stocks above certain moving averages or percentage of stocks that have beaten the overall index over some prior period of time. That's the problem right now. So what wouldn't bother me, even if we continue to see a bit of a sell-off driven by some of those larger cap names, is if we start to see some better participation. That was actually what was happening last October. You had a positive divergence because you had the indexes coming down courtesy of those big stocks putting downward pressure, but you started to see much more improved participation from a breadth standpoint down. So that would be the ideal situation, is a little bit of convergence. We're not seeing that at this point.
Lizanne, 2 weeks ago, we would have all been focused on earnings. We would have all been focused on what the tipping point was for equity valuations, given where bonds are and how much they've been swinging around. And now sort of this existential question is hanging over it all, especially after the weekend's events in the past week, which is how vulnerable is this equity market to an oil shock, to some other kind of shock? Usually it is going to be expressed in the price of crude. What's your sense? How much time have you been focused on that, given what we're watching, what we're seeing unfold in the Middle East?
Well, unfortunately, we're all at the mercy of the day-to-day news. So far, you haven't seen oil prices move up to take out the prior high. So I don't know whether that's near-term good news from an economic standpoint. I'm not sure that says much about where the conflict goes from here. Again, we're all at the mercy of the day-to-day news. But, it's hard not to think about the early 1970s and the 50 years back to 1973, and the fact that when you started to see the geopolitical pressure associated with the rise in oil, it was happening at a time where inflation was already bubbling up and the economy was weakening. There are times where you get a surge in oil prices for whatever reason, where if you've got much more strength in the economy and not a lot of inflation pressure, you don't see that feeder into the equity market to such a different degree. So I think, unfortunately, where we sit right now with general uncertainty with regard to inflation in the economy, if you were to add an oil price shock into the mix, needless to say, it would not be a good thing.
How much are you gaming that out? How much are you responding to client questions about that? Or are people just basically saying, we don't know what we don't know, we're going to keep going along with what we do know and just take things as they go?
It's interesting. I've been getting many more questions at client events that are about the deficit and debt and interest costs and fiscal situation and political dysfunction than we are about the conflict, possibly because they know our perspective on where the conflict goes from here is worse than most other geopolitical strategists, of which we're not one. So I think it's more of those domestic concerns, the rise in interest rates and what it means for our fiscal health that seems to be top of mind by our investors.
Lizanne, well said, as always. Lizanne Saunders there at Charles Schwab. Great piece over the weekend in Barron's on this, where we are now compared to where we were in the 70s. Crude production right now, you can bring it up on the Bloomberg terminal, 13.2 million barrels a day of production in this country. And like Liz, I'm in a similar position. That's all I've heard from a lot of people. The focus is not on energy security. The focus at the moment seems to be on the budget. The ability of this country to respond and support across multiple fronts, Tom, military escalation in the last 18 months.
At the IMF meetings, the most important person who wasn't visible was Tobias Adrian. He was locked in bilateral meetings, but he's had a fiscal sustainability. And the answer is that was what was percolating, except I would not say it was just U.S. deficit. Granted, it's a domestic issue. It's worldwide. These people have all these numbers tattooed to their brain.
But the dysfunction really adds this feeling of uncertainty. We may get some sort of vote this week on Jim Jordan, who basically is his bid to be Speaker of the House is dead in the water by all the reports that I was reading. There were some talks about Hakeem Jeffries on the Democratic side leading something with respect to bringing some bipartisan Speaker of the House. All I can say is the fact that we're discussing that and not some of these bigger issues that are suddenly driving the conversation in the investment world gives you a sense of where we are right now.
But it's some of the history, and I take your point, and it's really my first question to Anne-Marie away from the Eastern Mediterranean. Is this just percolating on a Monday morning of the middle ground gets together, maybe like what happened in the Polish elections? The middle ground gets together on Capitol Hill?
And supports a Democrat. That's a big ask, isn't it?
Yes. Historically, it's a huge yes.
It's not done.
This isn't Parliament.
It's not. You'd prefer that, wouldn't you? I know you would.
Know, it's wars of
I can't say that. You can say that.
That's what he's going to say.
I can't say that.
Order.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything. The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose sides.
Bloomberg. Context changes everything.
We're seeing tightening of financing conditions like it has never happened before. Our mission is to return inflation to 2% medium term, and we will. And it is happening as we speak.
What is troubling is the weak growth looking into the medium term. Second, inflation has come down, but the job is not done yet.
The job is not done. ECB President Christine Lagarde, Geert Gopinath of the IMF, speaking at Marrakesh at their annual meeting with Tom Keane moderating in Marrakesh, Morocco. TK, great job on Friday and through last week.
Well, also fun, and it was huge audience, and it was massive anticipation, and there's always a surprise. So everything's set up. There's 47 people helping me make this happen. Trust me.
You took the entourage.
It's like, no. It's like the entourage of PhDs who know more than me. So you're in the back room, and they all come in, and they say exactly what they want to do, which has nothing to do with the panel, of course. So we get out there, and I open with Gita to be polite. The managing director saying, the king of Morocco, blah, blah, blah. I go to Lagarde. I went to Ngozi of the WTO, the director general, got the typical Ngozi. I go to Lagarde, and it felt like an ECB press conference. I start in, I'm like, economic growth. And she goes, no, monetary policy. And it was like, I'm sitting there going, how much trouble is she going to get herself into?
You can tell us what you wanted to discuss. We mentioned this earlier in the hour, Tom.
Yeah.
Hardly talked about the bond market at the IMF annual meetings. I've got no idea why. When we were there in spring in Washington, that frustrated me as well. They seem to be having these conversations that are divorced from what is actually taking place in a world. And front and center at the moment is some real bond market volatility in the Treasury market. Geert Gopinath on your panel actually touched on it briefly, Tom.
Yeah.
We're finally starting to price some kind of fiscal premium, risk premium in places like Treasuries.
She brought it over to the World Economic Outlook, and you see the knock-on effects. When we say economics, finance, and investment, that's what we're talking about. To give us perspective on this right now, William Lee, chief economist at Milken Institute, serious tours of duty with IMF. Dr. Lee, thank you so much for joining this morning. Why does the bond market matter to people like you?
it really determines how it is that monetary policy affects the real economy. It's the bond market that's the key to the transmission channel of monetary policy. And I think one thing that we should be concerned about is that even though the IMF delegates were not concerned about the bond market, the Federal Reserve seems to be overly concerned about the bond market if they start talking about letting the bond market do monetary policy. The bond market's not the central bank of the United States.
Joyce Chang at JP Morgan made the distinction off of Barry Eichengreen's paper at Jackson Hole that this will have serious big country effect on EM. Do you agree that the future of, say, the Pacific Rim or broader Africa is affected by Jerome Powell?
You got it, Tom. When the dollar's strong, it starts to suck in capital from the rest of the world. And that's exactly, in some ways, the opposite direction that capital should be going, from capital scarce to capital rich countries. Now, granted, the United States is where productivity is highest, it's where innovation is greatest, and you can justify why it is that people want to invest in the United States. But to suck out even more capital from the emerging markets that need the capital, that's a problem.
But we need to dig into the bond market. When the Federal Reserve starts to allude to the idea they're willing to allow the bond market to do the work for them, it's a very specific part of the bond market. It's not the front end, it's not short rates, it's long rates. It's the 10-year and out. And that's where we're seeing all the volatility. Bill, can you talk to me about the effectiveness of that? Shifting the emphasis away from short-term rates to long rates in fixed income.
The usual transmission channel is that the short rates will influence the long rates, and it's really how it influences the long rate that allows the economists to try to forecast what monetary policy is going to do in terms of applying the necessary restraint. It's the long-term interest rates that are in the cost of capital. It's the long-term interest rates that affect the valuation of equities. So it's absolutely critical. But right now, what we're seeing is a rise in the term premium, and also, in some sense, a lack of credibility on the part of the Fed, and it's signaled by the fact that five-year inflation rates, very long-term inflation rates in the 10-year horizon, are starting to rise. And why is that? It's because people don't believe the Fed is going to take seriously its 2% target of inflation targeting.
So, Bill, do you find it odd that they're willing to outsource monetary policy to long rates without a firm, solid understanding of what's underpinning the move higher in long rates?
Well, it's a consequence of this, well, let the data determine what I'll be doing, and I don't know what I'll be doing until I see the data. This allowing the data to wag the monetary policy is absolutely the biggest mistake you can have. The Fed has always been objective driven. It always had policy targeting, whether it's intermediate targeting like money or interest rates, or final targeting like inflation or unemployment or both. But right now, to say that, gee, I am going to let the data determine what I'm going to do, and I won't know what I'm going to do until I see the data, that's nuts. And that means we have unanchored bond markets. And when the bond market's unanchored, it's going to be doing whatever it feels like. It's going to go up one week, it's going to go down another week. In fact, it can do it all within 1 week.
And that's what we have been seeing over the past few weeks, Bill. I am curious, though, given your study of the flow of money internationally, of some of the whys behind the volatility in the bond market, the rise in the long end of the yield curve. We were speaking with Dalip Singh of PGIM Fixed Income, and he was saying this is due to a lack of price-insensitive buyers in China, in Japan, from Asia. Do you buy into that? Do you think that that is underpinning why you have had an unanchored longer-term bond yield?
A lot of the capital flows are, in some sense, price insensitive because they're very strategic right now. China's at the heart of all this. I just got back from a month in Asia, South Korea, Singapore, and Taiwan. And I got to tell you, everyone I talk to has got China on their mind and trying to develop a strategy as to where I should park my money if I'm going to be taking it outside of China. And right now, in fact, people are being strategic and saying, let me start to use the political tensions that the U.S. and China are having by saying, let's add more U.S. content. Mexico has become a haven for a lot of strategic capital. To plug one of our Milken Institute reports that just came out, Mexico as a strategic partner is a report that my colleague Maggie Switek just put out, and it's worth reading because it tells you Mexico, imports from Mexico have now exceeded the level of imports from China. That's how important finding alternatives is right now, and that's determining a lot of the capital flows.
But you're talking about going into places that might benefit from China being de-emphasized as a trade partner. What about China itself as a buyer of U.S. treasuries? What about some of these other investors as potentially seeing U.S. government debt as an option?
China's not much in a position to do much as a source of growth for the world. It's not doing much except the fact that it has continual surpluses for the United States in terms of buying up our treasuries. In fact, China is going out of its way to try to diversify its reserves and go to euros and something else, even cryptocurrencies, in order to reduce the dominance of the dollar in the international monetary system. So it's not going to be behind the buying of treasuries going forward.
Hey, Bill, wonderful to get your perspective. It always is. Bill Lee there of the Milken Institute on the latest on the deficit, the bond market, Fed policy, and China. This is the latest from Stuart Kaiser over at Citi. Tactically positive on the equity market. Macro data, the FOMC, third quarter earnings are supportive. The flows picture is solid. Looking for an ETF, Tom, that tracks the NASDAQ 100, the Qs.
Yeah.
That's where he's bullish right now.
I'm going to call this an outlier. I'll let other people smarter than me say so, but I read every word of the Kaiser report, flat out bullish, flat out pushing against the gloom that's out there, but again, selective, and that's what we were talking to Liz Ann Saunders about. I don't think you buy the ETF on the Dow Jones Industrial Average. I just don't think that's a wise move.
Apparently you do up the
right
NASDAQ
now.
100, according to Stuart Kaiser. Let's go through it piece by piece. Payroll solid, jobless claims still low. Banks like JP Morgan boosting their outlook going into year end. And at the same time, the Federal Reserve, Lisa unwilling to step in and spoil the party. That's the sentiment story. Now give me the guidance, the outlook beyond fourth quarter. This was Julian Emmanuel's problem over at Evercore. I was talking to him about it on Friday. Like JP Morgan, the outlook into year end, it's okay. And then beyond there, it's like the unknown.
Which is the reason why Stuart Kaiser and others are saying, well, we can't see it, you can't see it, so just look what you got right now. And what you got right now actually is looking pretty good because so many people got caught up with becoming a recessionista, yours truly, that you started to, get away from the actual data on the ground, which was telling you something very different. And so now people are just looking 2 feet in front of them rather than trying to look more than 10.
I think there's people looking at 3 or 4 years, and they're looking at this pullback, like Stuart Kaiser, and they're using traditional security analysis to say, okay, I have to participate. How? The complete mindset now, John, is should I be in cash or not? And the answer is people like Gina Martin Adams or Stuart Kaiser saying, I have to participate. What's the intelligent way to do it?
Should I be in cash or what? What else should you be in? What's the alternative when you could pick
This
up
is
5%
a general state. Well,
into the absolute
institutionally
unknown?
a 60-40 portfolio, but the way the bond market's moving around now, I'm not sure what the 40 is.
Let's talk about that bond market move right now. Yields are higher, again, on a 10-year by 8 basis points. Let's call it 469 on a 30-year, right the way out to the back end of the curve. The 30-year up by almost 10 basis points again. 485 on a 30-year yield in America. The bond market is just absolutely crazy in terms of the intraday moves at the moment.
Wild.
In the FX market, the euro a little stronger, dollar weaker, 105.32. Equities firmer by 0.25% on the S&P. In the next hour, we'll head to Israel and catch up with Bloomberg's Ollie Crook alongside Bloomberg's Anne-Marie down in Washington, D.C., together with Jay Pawlowski of TPW Advisory. Jay Pawlowski, constructive on the outlook for this market. That conversation in the next hour. Live from New York City this morning with equities pushing just a little bit higher. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank? Is this new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Fiscal policy is out of control. Monetary policy has actually been doing its job.
When we see the Fed raise interest rates, the economy tends to evolve in a very similar level.
I think a lack of a move higher in rates is enough to give some relief to equities.
I think for the bond market, it's really what happens in investment grade that's so critical.
Treasuries are going to trade much more in line with fundamentals over time. This might be the beginning of a secular bear market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market positive here by 0.3% on the S&P. 2 weeks of gains. Can we make it 3? TK, what a tense weekend. It just felt like we were on the brink of escalation through Saturday, through Sunday, into Monday morning.
Our world of economics, finance, investment pushed aside by the geopolitics. In this hour, I believe we're going to Anne-Marie Horton and Oliver Crooks is in Tel Aviv, a fractious weekend.
Bramo on the brink of escalation and seemingly on the brink of a full ground invasion over the past week.
And Tony Blinken popping around the entire region, trying to have back channel, front channel, every channel conversations with everyone in the region to gauge out where they stand, how to prevent some sort of escalation. One thing that I felt over the weekend, I couldn't tear myself away from it, as everybody I'm sure feels the same. The lack of clarity was just shocking to me. As time went on, there was just this fog of uncertainty and misinformation put over everything. And I just started to feel like, we will only know it in retrospect.
Well, let's build on that. I think it's really important. The lack of clarity around one specific issue, hostages.
Yes.
This is a really, really important topic,
yes.
Lisa. It felt like over the whole weekend, we were on this brink of this full ground invasion by Israel into Gaza. It didn't happen. There was a sense based on several reports, and there's some conflicting reporting around this story,
yes,
whether it was the hostage situation that was slowing things down.
There was some discussion about Qatar and possibly Egypt helping to negotiate some sort of hostage release, that Hamas was asking for a number of Palestinian prisoners in Israel to be released in counterbalance. There also was a discussion about trying to avoid killing the hostages as they went into Gaza City. All of this is just in the sort of fog of back channel discussions as everyone works frantically to try to avoid a larger conflagration. I can't express how emotional and tense this is for everybody in the region.
Well, I think the emotion's there, but to John's point, I think this is really important. It's horse before cart, and to me, the hostage discussion right now is the horse, and I could be off the mark on that, but I just think it's front and center within all the different parties and the narratives going on right now.
So Secretary Blinken is back in Israel. There are conversations based on our reporting about the president, together with Chancellor Scholz of Germany, making a visit to Israel at some point. These back channel talks, Bramo, let's just breathe some life into that conversation. There are no formal diplomatic arrangements for the Iranians to speak with the United States. They have these back channels, so to speak. Jake Sullivan, the National Security Advisor, suggesting they used them, in fact told us they used them over the weekend, essentially to warn off Iran from escalating this conflict.
I mean, 2 aircraft carriers in the region also sends a pretty strong message from the United States. But yes, there was this feeling of, look, we see you, we get you, we're not going to accuse you formally of having orchestrated these attacks, but please do not encourage Hezbollah right to the north of Israel to get involved. And you have seen a tit-for-tat kind of escalation, but not to the degree of some sort of more full kind of ground incursion on the northern border. But that is really what people are trying to prevent.
Don't is a word we've heard repeatedly from this president in this country. Don't. Your equity market on the S&P 500 looks like this. Positive by 0.25% on the S&P. Yields higher by 8 basis points on a 10-year, 4.69 on a 30-year yield. The volatility in this bond market, intraday price action, unreal. 30-year yield this morning, Lisa, up 10 basis points, 4.85.
And whether this is doing the work for the Fed or not, we'll hear all about it. We've got a lot of Fed speak this week. I mean, the list is very extensive. It really is capped off with Fed Chair Jay Powell on Thursday, with our own David Weston at the New York Economic Club. We'll also hear from Philly Fed President Patrick Harker, New York Fed's John Williams, Richmond Fed President Tom Barkin, Chicago Fed President Austin Goolsbee, Minneapolis Fed President Neil Kashkari, Atlanta Fed President Raphael Bostic, Dallas Fed President Lori Logan. I feel like I am listing people at some sort of religious event, and we will hear from them. Earnings, meanwhile, Bank of America and Goldman Sachs on Tuesday, Morgan Stanley, Netflix, and Tesla on Wednesday. A lot of people focusing on the horse race between Goldman Sachs and Morgan Stanley. Others really on the tech earnings. Just how much are the Qs going to continue to outperform? And economic data, really retail sales. How much does the consumer still have to spend, especially at a time where the Fed's Beige Book on Wednesday, which, Tom, you read every week.
On it, cover to cover. Can't wait.
I mean, it may suggest some weakening, and then we'll get jobless claims that will not suggest any weakening.
Look, the anecdotes we've had from Fed speakers, regional Fed presidents, suggesting there is a slowdown, that they're hearing from people in their districts, Tom, that are telling them there is a slowdown in this economy. The problem that we have at the moment is payrolls knocked it out the park. Jobless claims are still incredibly low. And we'll see what we get from retail sales tomorrow, Tom, a little bit later this week.
Maybe lagging indicators and all that. I'll let our guests explain that to us. But it's the same story as it was 6-8 months ago. Except 6-8 months ago, we were certain there was a recession, and now there's just silence on it. I mean, there's no other way to put it. Why don't you bring in Handsome Jay Pulaski?
Is that what we're calling Jay?
Handsome Jay Pulaski.
Handsome Jay. Jay Pulaski will love that, Tom. He joins us now, principal and founder of TPW Advisory. Jay, keep it together. We'll have a serious conversation now. Jamie Dimon at JP Morgan says this may be the most dangerous time the world has seen in decades. If you park the rhetoric and focus on the numbers, this is what we got. A record quarter of net interest income, boosted the forecast for the year, reserve for loan losses coming in better than expected. Jay, do I follow the rhetoric or the numbers out of these banks on Wall Street?
Yeah, John, it's great to be with you guys, and thanks, Tom, for that compliment. I don't even get that at home, let alone anywhere else, so thank you. You know, John, it's interesting you picked that example because that was one of my examples that I wanted to use because I think it just shows the gap between kind of superficial first-level analysis and something deeper. The superficial first level is taking Jamie Dimon, one of the most respected bankers in the country, if not the most respected right now, at his word when he says things are as bad and as scary as they have been in decades. And then the second level of analysis is the actual returns of the bank, which were stellar. And I focused on one of the points you touched on, which is the release of reserves, right? So if things were bad, banks build up reserves when they're making money. Banks printed a ton of money. Between the three, JP Morgan, Citi, and Wells Fargo, net profit was up 34% year on year, 34%. So that's a perfect environment to increase reserves in case you're worried about this horrible environment. What did JP Morgan actually do? They actually released reserves because they over-reserved 6 months ago. Tom was talking about 6 months ago. 6 months ago, 7 months ago was SVB and big time bank concerns. That is not the case anymore. So I just think there's a tremendous gap between kind of all that's going on, which you led to in the prelude between the three of you chatting, and the actual reality underneath. So you can be very scared and very worried if you just read the headlines, but if you look beneath the surface, things are actually, I would argue, pretty good and getting better, most importantly.
Jay, the single paragraph in your note that you are simply out of the bond market is confirmed by the Bloomberg Total Return Index. It is on the precipice of making new lows. On a price basis, we're back to a 2016 bond market. What happens to the stock market if we get priced down higher yields on that aggregate index?
Yeah, no, that's really the big tension right now, Tom, right, between assets is, you know, the old 60-40 worked like a charm over the 2010 to 2020 period because rates were coming in, right, you know, massive bull market for a decade, and now we're having the reverse. And we wrote about the coming bond bear market several years ago. We've been out of treasuries for the last 2 years in our global multi-asset model portfolio, completely 100% out of treasuries, even though our benchmark is 40% fixed income. We have been in credit. We continue to be in high yield in the United States, for example, continue to be in emerging market debt, both local currency and corporate. But to me, the issue is the market priced in, particularly the bond market, priced in or priced out rather, excuse me, the recession call, right? The bond market was a big believer in recession, way more than the equity market. And when that story got knocked out by Jay Powell a month or so ago, when the Fed doubled their growth estimates for this year, significantly raised growth estimates for next year, took out 2 rate cuts for 2024, the bond market had to reprice at speed, and it has done so. And as long as nothing breaks during that repricing, then we're okay. And I would argue that we're much closer to the end of that repricing than we are to the beginning. Real rates are high. 10-year real yields are about 2.5%. Historically, that's quite high. Inflation is coming down significantly, and we think will continue to do so. So I'm, as I mentioned, I think last time on the show, contemplating bonds is an interesting opportunity. They rallied very aggressively, and that took away the opportunity. But between 450 and 475 on the 10-year kind of makes sense to me in the environment that I think we're going into, which is continued solid, decent economic growth in the United States into 2024 and beyond.
Well, Jay, just quickly here, then is it time to transfer out of corporate debt, especially as we just heard from George Concalves, the tip of the iceberg with Rite Aid and defaults and bankruptcies, and go back into treasuries?
You know, that's, I don't think so. Personally, at this moment, I don't buy the default story in the high yield market. That's not really being supported by broad data. Yes, you can pick out cherry-pick individual names, but the reality is that defaults are quite low, and there's no real indication that they're going to pick up dramatically, particularly if the economy is going to be okay. And the big issue for high yield is the refinancing issue, the refi mountain, as it's called, and that in high yield in the U.S. doesn't come for 2 or 3 years. So we think there's pretty much still opportunity. In our view, where we want to be, we think the global economy is picking up speed. We're in the early stages of a manufacturing recovery around the world. Earnings next year in the U.S. Forecast to be up 12%. Equity market should be fine in that environment. We want to be in commodities for that strong growth opportunity. We like emerging markets. We like China, as we talked about on this show before. And so that's where we see more opportunity than, switching into U.S. Treasuries. I don't think there's a lot of downside from here, but I also don't think there's a lot of upside, and there's better opportunities upside, risk-reward basis elsewhere than U.S. Treasuries.
Maturity mountain. I'm going to use that, Jay. Handsome Jay Poloski, the TPW advisory. Is that going to catch on, TK?
It is. It's a substantial. It's a substantial idea.
Nice. If you're just joining us, welcome to the program. The S&P positive here by 0.2%. Yields a whole lot higher by 9 basis points. Look at that, Lisa. 470 back at 470 on a 10-year. Go further out on the curve, 30-year, up by 10 basis points. Let's call it 486 this morning.
And so we could close either at 480 or we could close potentially at 450. We don't know, because that's basically been the ride that we've been on. And the why behind it has been so unclear. It has gone down, yields gone down in light of better than expected economic data, and it's gone up in response to worse than expected economic data. Go figure.
Guys like Jay Pulaski are hardwired to this. We look at price, and when we shift from a yield analysis or spread analysis, and it's like, oops, price, you look for benchmarks. The Vanguard Total Bond Fund, and this doesn't include the income. This is just on a price basis. It's paying income along the way, so-called carry, John. It's down 21% from June of 2020. Along that 3-year-ish period, it is down 7.3% per year. Operative word for us and fancy people in Marrakesh, never. Never seen it.
This bond market has hurt this financial sector. On the banks a little bit later, Erica Najarian of UBS. In the next hour on the market, Peter Cheer of Economy Securities. Next on this program, on the ground in Israel, Bloomberg's Ollie Krug on the latest following a weekend full of diplomacy. And we'll catch up with our chief Washington correspondent, Anne-Marie Hordern, live in DC next.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We need Congress to act, and the president has made clear that he is going to go to Congress with a package of funding for Ukraine as well as continued support for Israel. You can expect intensive engagement with Congress this very week as we work on such a package and seek to secure bipartisan support for it.
That was Jake Sullivan, the U.S. National Security Advisor on CBS, speaking of intensive engagement with Congress this very week. We've had an intensive weekend of diplomacy. Secretary Blinken back in Israel after spending the weekend at one point in Riyadh with the Crown Prince Mohammed bin Salman. The big takeaway from that conversation with Jake Sullivan, the National Security Advisor, this quote right here: "We have means of communicating privately with Iran, and we have availed ourselves of those means over the past few days to make clear privately that which we have said publicly." And as we know, Tom, what they have said publicly over the last week is don't, and warning off Iran of any escalatory moves.
Yeah, I hear different narratives here. And you mentioned this, John. I believe we weren't on air, and I think it's very, very valid. There's got to be all sorts of other stories, many covert, going on. I don't think we're fully informed, and I wonder, are people like Mr. Sullivan fully informed on what's really going on the ground, that's what's called a war.
Well, officials are trying to discern a lot of details, including how many hostages, you mentioned that, were actually still being kept in Gaza. Now the number is something like 199, according to the latest reports. How this is featuring into discussions with Iran, especially since a lot of those people are nationals of other countries as well.
If you are just joining us, welcome. I want to get you up to speed on what's happening elsewhere as well. On the equity market, on the S&P, positive here by 0.25%. Equities drifting a little bit higher, really divorced from what we're talking about at the moment with regards to what's taking place in the Middle East. Yields a little bit higher here, Tom, up 9 basis points. The 10-year, 470.
Right now, we're going to continue our coverage. Anne-Marie Horton is in Washington, our chief Washington correspondent, and Oliver Crook is in Tel Aviv this morning. Oliver, just simply translate us away from 9 news sources, all the TV, the blur of the news. What did you observe in Tel Aviv this weekend?
Well, it's very, very quiet here, Tom, and amid the war that is going on in the south and some of the skirmishes that are going on in the north, in Tel Aviv, there's a sort of very eerie calm. We, in our bureau, and where we're positioned right now, is on the Rothschild Boulevard. This is a very active part of town. I was here just 7 months ago. There are tons of people out in the streets generally. It is completely quiet. Life has come back a little bit today, but most of the businesses are closed, and there's a great despondency here in the streets. And of course, people in Tel Aviv are not accustomed in recent years to go to bomb shelters, as we've done several times over this weekend, about 2 times a day since Friday.
Ollie, there is this uncomfortable quiet that you speak to. Let's build on that. All weekend, it's felt like we're on the brink of a full ground invasion. From the reporting that you've done, Ollie, from the people that you've spoken to, what's preventing that from happening anytime soon?
Well, the question, John, is, again, what kind of invasion are we talking about? Because is it just everybody rolling in? Is it tactical operations? We understand that there were some tactical operations in Gaza as early as Friday. But what we understand now is, as we know, hundreds of thousands of troops that are amassed on the border. The thing that the Israel Defense Forces did confirm this weekend is that the next step will have a ground component. Air, sea, and ground, they said. The question is of when. And now with all of these leaders now coming, potentially Schultz tomorrow, and if Biden comes, potentially, is that held off for another period of time? I think it is very hard to say. Again, on Friday, the message from the Israelis was, we have not decided yet officially to move in. But again, that has evolved over the weekend.
And Marie, as Ollie indicated, we've had a weekend full of diplomacy. Secretary Blinken in Riyadh, back in Israel. Talk to me, Anne-Marie, talk to us and explain to us what's come out of that weekend full of intense diplomacy.
Well, the first thing is that Secretary Blinken, after he left Cairo, there seemed to be this understanding that they would open up that Rafah border crossing. That'll be incredibly important for these American Palestinians that are trying to get out, Palestinians that are trying to get out of harm's way, as the Israelis have told them to move away from Gaza City and towards the Egyptian border, and also humanitarian aid that the UN says is waiting on convoys on the Egyptian side to come in. The issue is, although it does seem like there's a diplomatic push for this, that Rafah border crossing has yet to be opened. So that's something key that came out of that discussion from Secretary Blinken over the weekend. And now he's back in Israel on the same day that we do have reports that Benjamin Netanyahu, over a phone call over the weekend, invited President Biden to actually come to Israel to show his support, and Blinken decided to stay in the region. So I would say there is this potentially, of the President of the United States going to Israel. First and foremost, this would be a huge show of support to the Israeli people. It would also deter this conflict potentially from expanding. It would be a huge deterrence to, say, Iran or Lebanese Hezbollah if the President of the United States shows up in Tel Aviv. It would also explain why the U.S. is sending a second aircraft carrier to the Eastern Mediterranean.
Right. Well, that's exactly where I wanted to go, Anne-Marie. Those aircraft carriers that are going over to the Mediterranean, one already positioned there. Do we have a sense of what the red lines are? And I keep going back to this, for when the U.S. will get involved, when they will actually start to deploy the troops and the hardware that they've put floating on the sea.
Well, Admiral Kirby said there's no reason for there to be U.S. troops, U.S. boots on the ground. The Israeli Defense Forces have the capabilities. They have the U.S. backing and supplies that they need. But these two aircraft carriers really just are a massive show of force. And you have the Eastern Med now, well, once the USS Eisenhower arrives there, you'll have the Eastern Med, you'll have it completely armed to the teeth. This is a huge deterrence to Tehran or any other actors that may want to get involved in this conflict.
Oliver Crook in Tel Aviv, I've got a clear understanding of how the Pentagon is related to Washington, to the executive branch and the legislative branch. I don't have a clue about the Israeli military. Who are they listening to now? Who gives the Israeli military guidance on this Monday?
Well, it will be this wartime cabinet that has been assembled by Benjamin Netanyahu, over which he presides, which has brought back together a great deal of the Israeli political spectrum, which again was the sort of main story when I was here last 7 months ago, the huge division within Israeli society that has really come back and coalesced in this wartime. Most of the government posts are in Jerusalem. The defense ministry is here in Tel Aviv. It's just behind me, actually. And so that's where the orders are going to be coming from. I mean, the defense forces will make their own sort of assessment in terms of how to execute, but it's going to come down from that wartime cabinet.
Anne-Marie, let's finish on this one. Israel was criticized by many going into the weekend for that 24-hour warning that it had given. You touched on the humanitarian corridors, water, electricity, fuel. AMH, what's the latest?
Well, the UN is out this morning with their update that these supplies are quickly dwindling and there's not really a lot left when it comes to Israelis. There does seem to be some clean water in some areas that were turned on by the Israelis for the Palestinians living in Gaza, but this is a dire humanitarian situation that individuals in Gaza are experiencing, as they all as well try to flee. And some of them are even being blockaded by Hamas. And you know, if we learned anything from the 2014 conflict, it's that Hamas also will use humans as shields. They will store their weapons or have their headquarters in places like hospitals or schools.
Anne-Marie, is Egypt cooperating at the southern border?
Good question.
Well, it's very challenging right now. Egypt definitely wants a lot of aid from the United States, but Egypt also is saying, if we let a lot of Palestinians in Gaza into Egypt, what does this mean for the future? How are we supposed to look after these people? They're under a tremendous amount of pressure to really get this Rafah border crossing open. At the moment, though, we are not seeing a lot of movement there, even though this is at the highest levels. President Sisi sat down with Tony Blinken over the weekend.
Tremendous reporting, Anne-Marie, as always, over the week and over the last few days particularly. Ollie, stay safe. It's good to hear from you. Ollie Crook there, over in Israel, in Tel Aviv. If you are just joining us, welcome. Plenty of diplomacy taking place, Tom, through the weekend, and talk this morning, based on our reporting, that the president might be getting ready to make a visit to Israel.
And on the southern border here, it's very important to say that there's one conduit, one gate, if you will, to go back to biblical times, where there can be an exit. The gate right now, I believe, Lisa, is closed. And to me, and this was actually the major theme at Morocco, was the place of the Egyptians in this, and it's a chaotic society. I mean, the demographics of Egypt and their financial standpoint is simple. They want U.S. aid as a bargaining chip.
Well, and they also are concerned about certain factions within their own population and how they will respond and what they might sort of be influenced by should some of the people from Gaza head into their nation.
And much more on this story through this morning. Coming up next, Sonia Martin of DZ Bank on foreign exchange. Your equity market slightly higher from New York. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the US and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
Squeezing out a second week of gains on the S&P 500, coming into a new trading week. Your equity market positive, elevated by 0.3% on the S&P. The Nasdaq turning higher as well, up by 0.06. The small caps bouncing back. The Russell up by 0.75%. What a move in the bond market again last week, even with a single day. Remember, there was one day last week where the 30-year rose almost 20 basis points, and even with that, the 30-year yield was lower on the week by more than 20 over the week. Get your head around that. On a 10-year yield, higher this morning by 9 basis points, higher by almost 20 basis points, or lower rather, last week by almost 20 basis points. Keeping up to speed with this is absolutely insane, Bramo. 470 right now on a 10-year, 486 on 30s.
I've stopped trying to give reason to it. You can come up with your virtual reasons on one side or another, but it's such a hard thing to predict, which raises a question: do we really understand what's behind this? And if we don't, to your point, I think it was a really good one, how can Fed officials lean on this so substantially and say it's not necessarily dysfunctional, it's doing the work for them, if we don't really know why it's happening, why there is such an incredible amount of volatility?
Well, they certainly have credibility at the front end, because the 2-year last week was essentially unchanged, even with PPI coming in hotter and CPI a little hotter as well. The 2-year right now just still in and around 5%. Even with economic data coming in just a touch stronger, TK, there is a belief that this Fed will be unmoved in November.
But again, the parlor game is open to the data. We've had some very important data. That jobs report was okay. And, you know, the inflation data, we got as a retail sales tomorrow, I believe, fine. But the different narratives out there wrapped around the, you know, the Dow 10,000, a 5% 10-year yield, I don't have a clue. I'm just waiting for the data.
If Chairman Powell wants to make the November meeting a live meeting, he has one more opportunity going to the
David Weston could crowbar it out of him this Thursday.
David Weston, Chairman Powell, Economic Club of New York.
Chairman Powell, which way? Whether the 5% yield?
Just tell us. Yeah, get the price target from Chair Powell. Looking forward, our good friend and colleague David Weston sitting down at the Economic Club of New York with the Chairman of the Federal Reserve this Thursday. We'll take that for you right here on Bloomberg TV and on Bloomberg Radio. Under surveillance this morning, Israel announcing another safe corridor in the Gaza Strip as it tells Palestinians to move south ahead of a potential ground assault. Egyptian officials confirming convoys of humanitarian aid are ready at the Rafah crossing, although it remains unclear when or if it will open. Gaza remains under siege, Lisa, with no supplies or power allowed in.
And we've been talking all morning about the uncertainty behind some of the negotiations. We've heard a lot about Rafah and the crossing there and how Egypt is negotiating with the U.S. and Israel to figure out how to let convoys of humanitarian aid in, screening them to make sure that they don't have weapons and other things that Israel is concerned about, while also letting nationals of the U.S. and elsewhere out of Gaza. It's really tricky, though, because how does Egypt justify letting a select number of Gaza residents out because they have relationships with other countries without igniting the anger of their own population who are protesting the fact that there is not an open border and that there hasn't been more humanitarian aid given?
These are modern debates. I mean, when we prosecuted wars in other times and places, civilians just simply were in the way, and it was tragic, and always in every case. I just am unsure for the Israeli military, what is the narrative they're listening to right now? I don't think that's been made clear.
I'll just say this, that if you talk to anyone in Israel, people are very united. They're very clear, especially given how many people were killed, how they were killed, how many people were abducted. There is a clarity in Israel, complete disagreement politically, but a clarity among Israelis about what they want to do.
The website doesn't matter, but it's an acclaimed global newspaper, John, and the answer is there were 8 or 9 narratives lined up collegially because these are the 8 or 9 narratives of the moment. I don't think the Israeli military has 8 or 9 narratives right now.
Elisa mentioned that domestic support in Israel. Domestic support here as well in America. We mentioned this poll in the previous hour. I think it's worth going over again from CNN. Ahead of this expected ground invasion of Gaza, most respondents to this poll, Americans, said the Israeli government's military response to the Hamas attacks is fully justified. That was 50%, partially justified 20%. A total of 21% said they weren't sure. Tom, only 8% said it was not justified at all. I think it bears repeating what we talked about in the previous hour. All through the weekend, there's been talk about controversial stories on campuses at American colleges, a lack of support for Israel. That poll, Tom, does not speak to that at all.
Well, no, the poll doesn't talk the narratives that you're seeing out there at all. And of course, you'll have to see how the poll adjusts, and it awaits the Israeli actions that clearly in the last 24 hours, but frankly, even 48 hours that we've been waiting for on a Monday. Who knows? You know, do I care what the Secretary of State's doing right now versus what is the Israeli military thinking? I don't know the answer.
Escalation abroad. We've talked about dysfunction at home. Let's do that again. House Democrats now looking for a bipartisan solution to find a speaker. Minority Leader Hakeem Jeffries telling NBC, quote, there have been informal conversations. When we get back to Washington, it's important to begin to formalize those conversations. Democrats have refused to vote for a Republican speaker after Congressman Kevin McCarthy was ousted earlier this month. Final story for you, the US. Looking to further restrict China's access to advanced chip technology. We're reporting new measures will close loopholes and make it harder for Chinese firms to get chips and chip-making equipment needed for AI. The Biden administration expected to make the announcement, Lisa, early this week. So we're getting a lot done all at the same time down in the White House.
We're getting a lot done, raising some questions about timing. When I read this, I'll be completely honest, I wondered if this had been in the works for a long time. They were asked to be a little bit harder with respect to some of those restrictions, whether this came out now and whether the timing is somewhat inconvenient at a time where it does muddy the waters of diplomacy. A lot of people looking at China and saying, okay, well, how are you going to keep things from spiraling out of control in the Middle East? Well, this doesn't really necessarily help the cause. At the same time, it's after the phone and them and China showing that they can develop their own chip technology. So a lot of uncertainty about the timing to me.
It is October 16th. If you went through the week ahead guidance for the White House, it read as follows. The president will travel to Colorado to visit CS Wind, the largest wind tower manufacturer in the world. This headline just crossing, Biden's trip to Colorado is postponed, will be rescheduled. The latest on the president's movement, Tom, ahead of a key week in terms of diplomacy and potentially military action, one, but also two, in the context of a report that we've put out earlier on today, indicating that there is a consideration at the White House for the president to make a visit to Israel. It's up to you whether you draw a line between the two stories. I'll just give you the news. He was going to Colorado today. It's been postponed. Tom, it will be rescheduled.
I think it's very fluid here, and all we have left is up 9 basis points as the 10-year yield is, dare I say that U.S. 10-year is the thermometer of where we are right now. 10 basis point move, 4.70% on the 10-year yield. This is a joy because this is what we do at Surveillance. We go deeper. The stereotype, particularly for our U.S. audience, is Deutsche Bank and maybe Commerzbank is banking in Germany. Anybody who's a student of it, like, say, Adam Posen, would say, well, that's not quite true. John, you're going to love this. The Deutsche Zentralgenossenschaftsbank.
Nice. DZ Bank.
DZ Bank. DZ Bank is really important in Germany as a cooperative bank of millions of voices. Sonia Martin joins, FX and monetary policy head of DZ Bank of Germany. Sonia, wonderful and well-timed to have you on. How do you link what is clearly a slowdown of economic might in Germany to a weaker euro?
Well, yeah, it is somewhat surprising. We have seen, a lot of very weak data for some time now. I mean, I think there is very much clarity on the fact that the Eurozone is really struggling, and I think the data that we're going to see this week is only going to confirm that. Yet, we have seen Eurodollar falling, and I think, to be honest, that's a combination of two factors. We have seen, on one hand, the softness in the Eurozone, but I think also very much this is a dollar story. We have seen people become increasingly optimistic on the U.S. I mean, all those recession fears have sort of gone out the window, really, haven't they? So I think that's kind of been the driving forces in that currency pair for the moment.
Sonia, I was scheduled to speak with Joachim Nagel in Marrakesh, and he unfortunately had to cancel that meeting due to really pressing issues right now. What are the pressing issues of the Bundesbank as they look at foreign exchange and, again, the real economy slowdown in Europe?
Well, I mean, everything else being equal, obviously a softer euro is not exactly bad news. In fact, we might very much welcome a somewhat softer currency in this general global environment because, we still are very much, if you look at Germany, an export nation. So, we're going to benefit from a weaker currency. At the same time, the problem is, of course, that with a weaker currency comes potentially more inflation. And that's, of course, something we don't want to have right now. We want inflation to come off, the recent highs. We want it to come back to these targets. So this is kind of a bit of a juxtaposition. Weaker currency, yes, but not too weak, because then we have an inflation problem again.
How much are we hearing, Sonia, a sense of ECB members following along with what the Fed said, saying the bond market's doing the work for us, so we don't have to raise rates on that much further?
I think it's interesting. I think you mentioned earlier as well. It's interesting the way that the Fed has phrased this, because in a way, by saying the market is doing the job for us, what you're really saying is we don't have to hike rates more. They may not have to stay high for as long, and that ultimately could, of course, end up depressing rates again. So it's a bit of an odd way to phrase it for them, I think. This is not something that we've heard very much about in the Eurozone. I mean, the ECB hasn't really spoken about, anything in that kind, the market is doing the job for us. That hasn't really happened here. I think the big discussion that's happening in Europe, in the ECB right now, is this division between the hawks and the doves, and the question of, yes, we no longer see any need to hike rates further, but we need to talk about other measures to reduce excess liquidity. We need to talk about PPP reinvestments, et cetera, et cetera. So that's the big debate that's happening, I think, at the ECB at the moment.
A lot of people also are wondering when the market will really reflect some of the angst that we've been talking about all morning in the Middle East. There isn't necessarily a clear read-through unless oil starts to get involved. And if oil prices spike, just how vulnerable is the euro?
Yeah, it's always odd, isn't it? I mean, there's something happening that's so dramatic, and the financial market takes a sort of very, I'm going to say, jaded view. We don't really care as long as it doesn't affect the oil price. I mean, it really is kind of bizarre. But yeah, that's evidently what's happening. As long as oil isn't involved, then the bigger impact on the financial market isn't really going to be huge. If oil gets involved, this is going to be a big problem, because of course, as we have discussed, we've just coming out of a high inflation era, and we're going back to hopefully towards more normal inflation rates. And the last thing we need, both on the inflation and the growth front, is of course a surge or lasting surge in the oil price. And that's because that will be detrimental really both to growth, and it would obviously also push inflation rates high again. So the worst of both worlds really.
Taking the temperature for the potential of broader escalation in the region. Crude right now 90.65. A little softer on the session. Sonia, thank you for being with us. Sonia Martin there at DC Bank. Just an update on the news we got just moments ago. The president had been due to travel to Colorado to visit the largest wind tower manufacturer in the world. The latest we understand from the White House, the president's trip to Colorado is postponed. It will be rescheduled. The president will remain at the White House to participate, Tom, in national security meetings. That crossing just moments ago.
Well, it's got to be that, and in real time as well, and also to the diplomacy and what he can affect is in talking with allies, less talking with Israel and talking with, there's intractable issues here that Israel's going to do unilaterally. But the real question here to me is, what does he do in dialogue with the allies, such as Mr. Scholz of Germany?
If you are just joining us, welcome to the program. The S&P 500 shaping up as follows this Monday morning, positive by 0.3%. Crude a little bit lower by 0.1%, 87.58. The team here at Bloomberg, Jennifer Jacobs, Justin Singh, reporting the president is considering a trip to Israel. This line is important, though, according to two people familiar with the internal discussions, Lisa. No decision about whether to travel to Israel has yet been made. That was our latest reporting. Indications this morning that trip to Colorado postponed. and postponed because the president will remain at the White House to participate in national security meetings.
The security around some sort of trip like that has to be pretty shocking. I was reading over the weekend all the stories about how the Tel Aviv airport remains open at a time where they are fending off certain kinds of attacks. The question that I have on a broader level is just that we don't know what is holding back the ground invasion. As you said, we don't know the state of the hostages. We don't know how many of them are Americans, and we don't know the red lines that either Iran, Hezbollah, or the Hamas militants could cross before the U.S. gets involved, before some of the other nations in the region get involved.
This is our new war. Could you imagine LBJ slipping away to Vietnam or having a debate of dashing off to Vietnam and many other
What Lisa's getting at
analogs
is
as
important
well.
here, TK.
Yeah.
Is it a distraction? Is that the kind of security distraction that country needs at the moment, which will be part of this consideration, I'm sure, on the ground in Israel? Coming up next on the bank earnings still to come this week, Eric Najarian of UBS.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
I think operationally, this was a good quarter, both on the consumer and commercial lending. One scenario that hasn't been talked about, with the Fed possibly with a rate pause, is that with rates staying high, and if the banks can hold the line in terms of deposit costs, they can enjoy net interest income growth.
JP Morgan has been enjoying that net interest income growth. That was Ken Leon, Director of Equity Research at CFRA, following results on Wall Street on Friday. More still to come. Before we get there, let me update you on the president's movements. He had been due to travel to Colorado to visit the largest wind tower manufacturer in the world. The latest from the White House, this quote right here: the president's trip to Colorado is postponed. It will be rescheduled. The president will remain at the White House to participate in national security meetings. Our reporting here this morning here at Bloomberg that the president is weighing a trip to Israel. No decision, according to two people familiar with the internal discussions, no decision about whether to travel to Israel at this point, Tom, has been made.
Well, it hasn't been made, but to Lisa's delicate point, and I think Lisa said this with immense respect, I mean, do we need a distraction of this? Pick the geography of Israel right now. I mean, it's not something for me to spout about, but certainly it will be part of the zeitgeist over the next 12 hours.
Well, there's two very, very simple options, Tom. Distraction, one, potentially. Two, talk about a display of support, Ramo, for the President of the United States to go over to Israel. at this point.
And a lot of people said that Tony Blinken and his words and the show of support and the aircraft carriers, et cetera, have been incredibly heartening for those in Israel. There is a question, though, about how much this complicates some of the other diplomatic relations as well at a time of incredibly delicate negotiations. We can't emphasize this enough at a time where a lot of governments of some of the Middle Eastern nations are not in total alignment with the majority of their populations, which are increasingly having protests.
A weekend of really intense diplomacy, much more on that throughout this morning on Bloomberg TV and radio. If you are just joining us, your equity market looks like this on the S&P 500, positive by 0.4%, yields higher by 9 basis points on a 10-year, 469.97. The next couple of days for bank earnings shaping up as follows. Bank of America just around the corner. That's a big one to watch. That stock absolutely hammered. B of A down something like 20% TK year to date. Goldman Sachs coming up tomorrow as well. Then it's on to Goldman. Past that, it's on to Morgan Stanley on Wednesday.
They all have value, but I'm fascinated, John, by what Mr. Moynihan does to provide fixed income price clarity across his ginormous platform. And one outcome is to say, wait for next quarter. Maybe it won't be visible here, but it'll be visible 90-day report, hence.
This quarter for JP Morgan, Tom, not bad, eh? Boosting the outlook into year-end as well.
It was terrible. I mean, they're struggling, and, it's tough.
Wasn't that a record quarter for net interest income?
Yes.
Joyce Chang showed up on stage with a cast on one of her ankles. She tripped over a concrete block at the construction site.
Really? In Morocco?
Yeah. No, she tripped over a concrete block at the construction site.
You're making up stories,
on
aren't
Park
you?
Avenue.
Okay.
No, I would never do that.
Just in case any relations of Joyce are listening, Joyce is okay and hasn't
Joyce is okay.
I mean,
Why are we doing these
No
things?
idea.
Joining us now to save the show, Erica Najarian, large cap banks and consumer finance equity research analyst at UBS. She is not wearing a cast on one of her ankles this morning. Erica,
How do you know?
I did. Thank you. I look, Erica, at where we are right now, and if I look at the Keefe Bruyette Index, we're down 48% from the nirvana that we did in 2022-21, and we've only got 26% down to go on a blended bank basis to get to COVID lows. What do they do to turn the ship around?
So it's pretty simple, and I think that they essentially have to disprove the negative, which is that higher rates is only bad for banks, or higher rates are only bad for banks. As you could see in the earnings results so far, that's not actually the case. A lot of these banks have the raw material to make more money in a higher interest rate environment, which is a good deposit base. But what we've seen early this year with the 3 bank failures is the dark side to higher rates. What happens when you're offsides and rates go up faster than you think? And so what the market really needs to see is you're not seeing massive capital losses, you're seeing deposit stability, and you're seeing net interest income progress in the right, in the right direction as they earn more on their assets and their liabilities.
I mean, correct me if I'm wrong, but Erica, the history to me is called synergies or cost cuts or moving things. Are they to the bone now where they can't cut anymore? Are they going to choose which divisions to participate in into 2024? Or is it just going to be, cut 4%? Let's go.
I think that might not be the right question to ask unless it's someone like Citigroup that has a very specific expense cutting plan. Keep in mind that these banks are actually making a lot of money right now. They're making a lot more in net interest income than they did last year. Trading has been resilient. Investment banking is cyclically depressed but could bounce back. And so a lot of these banks understand that you can't necessarily cut your way to glory. And so while we think they're going to be mindful of expense growth next year, I think that the question really is, how do they, think about revenue resilience next year? How do they, maintain deposit costs at a certain level if the Fed does pause in order to enjoy fixed asset repricing? I think the question is more about keeping deposit costs, or rather keeping operating costs at a lower growth rate than revenue growth, rather than outright expense cuts at this point.
Erica, they're making bank, let's be honest, right? They just had a record quarter, as John was mentioning, for net interest income. If they are doing so well and they have surprised the upside and they're not putting as much to the side to cover loan losses as many people expected, why aren't the shares doing better?
Because a lot of investors are still really fearful of what could be the consequence of higher rates, and the rapid increase in rates, which is a recession. And at the end of the day, a lot of these banks are, like you say, making bank from a revenue perspective, especially on net interest income. But a lot of investors are fearful that we'll see higher credit losses, whether it's on the commercial real estate books or, corporate books or, the consumer weakening. So right now, the valuations are staying cheap because a lot of investors are essentially saying, well, I'm going to wait till I really understand the complexion of the downturn before I really step in and, really call these stocks inexpensive.
So how much are you getting pushback? How much are you recommending to investors to buy certain bank stocks and making the argument they're undervalued because of this uncertainty, and yet they're increasingly acting like utilities because of how much capital they've put aside and how regulated they've become?
Look, I think the reality is that the banks are in a little bit of a trading range at this point. So, you brought up 2 points. One is macro and one is regulation. Near term, we do think that the rubber band has stretched a little bit too far and they're at the low end of their trading range. And they are a little bit too inexpensive, relative to the reality of their earnings power today. That being said, you bring up a good point. Not only is the uncertainty over the economy really tamping down what their multiples could be, right? But also you have a lot of new rules that are coming down the pipeline. That being said, I like to describe the new rules in terms of what's coming down the pipeline as tough, but not nearly as, game changing as it was coming out of the financial crisis. If for money center banks, the regulatory landscape went from 0 to 10. I feel like Basel III Endgame and the upcoming liquidity rules, it's going from 10 to 12. And perhaps from regional banks, it's going from 8 to 11.5. But either way, I think what I'm recommending to investors is, look, take advantage of these prices at the low end of the trading range, but valuations are not really going to be able to re-rate meaningfully to normal levels relative to the broad market until we get more certainty, more clarity on what the economy looks like over the next 12 months.
Erica, good to hear from you again. Let's do it again soon. Erica Najarian there of UBS going into bank earnings tomorrow and Wednesday. The likes of Goldman, Morgan Stanley, Bank of America still to come this week. Big question for us. Can this administration, this White House, this country afford an escalation on 2 fronts worldwide? Peter Cheer of Academy Securities is going to join us in about 5 minutes' time. The President of the United States said this over the weekend to 60 Minutes on CBS. We are the United States, the most powerful nation in the world in history. Went on to say we can take care of both of these and still maintain our overall international defense. Janet Yellen, the Treasury Secretary, was asked the very same question by a British broadcaster, Sky News. She said this, Tom: America can certainly afford to stand with Israel and support Israel's military needs, and we can also and must support Ukraine in its struggle against Russia. What do you make of the very fact that this is a question that's being asked of this administration, this
It's always, in American history, John, it's always been asked. This is true of all of American history. And what was interesting, and Yellen was incredibly visible at Marrakesh, and some would suggest hardworking on the theme. She was there. She's in Luxembourg at the finance ministers meeting. I believe it's this morning. But John, the key thing here for Janet Yellen is American exceptionalism. We really stick out for growth that we can afford to support these 2 war platforms.
Peter Cheer of Academy Securities on that story up next. Your equity market right now positive by 0.3% from New York. This is Bloomberg.
I'm part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger. But obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. So this is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. And this is a promising area.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I was putting so much pressure on myself. And when I changed my mindset midway through the tournament and just approached it one game at a time.
Lloyd with Morgan streaking. She's chipping the goalkeeper! Off the post and in! Hat-trick for Lloyd!
I went from really just being under the radar to suddenly being in the spotlight.
You know who I'm talking about, Carly Lloyd! Carly Lloyd! Ladies and gentlemen, we have an American hero.
I had speaking engagements, sponsors that wanted to sign me, appearances, you name it, I had it. It became very mentally draining for the next easily couple years because I was extremely busy. But I knew that if I'm going to have any type of retirement, any type of financial stability when I'm done playing, I had to take every advantage of my opportunity.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
The reason why people, including ourselves, have been too bearish on the market is that we've seen a slowdown coming and it hasn't manifested.
I'm still in that rolling recession camp. Indeed, in some areas, it's starting to look like a rolling recovery.
In the short term, I think there's an investable market rebound here.
The Fed is going to be a very muted player whenever that deceleration in the economy does arrive.
Until we hit recession, we are probably not going to see a definitive macroeconomic narrative driving the market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television across this nation and worldwide in this hour. Peter Cheer to be with us in a moment. Economics, finance, and investment. No, John, it is oil. It's a single metric we have, bouncing off $91 a barrel Brent crude on the geopolitics, the war of the Eastern Mediterranean.
That has taken a temperature right now of the potential for escalation in the conflict between Israel and Hamas. Right now, $90.68 on Brent crude. At the moment, the challenge for investors, how on earth do you do this? Process two opposing ideas simultaneously. When a bank CEO turns around and says this may be the most dangerous time the world has seen in decades, then the very same bank reports a record quarter net interest income, Tom, and boosts its outlook.
You're going to see that. You're going to see this partition here of business as normal, maybe even in America, a better than good real GDP against these two war platforms. On the break as we begin this hour, we were talking about how you have two war platforms, and the president fully focused on national security today. We'll address that.
That's the international story. Need to talk about the domestic one as well. Important economic data this week, Tom. Retail sales come up tomorrow. Tons of Fed speak. It's worth talking about this again. Chairman Powell sitting down with David Weston, Economic Club in New York, on Thursday. The last opportunity for the Federal Reserve to indicate what they may want to do on the 1st of November.
My guess is Chairman Powell will say, first, do no harm. But we'll have to see on that. Lisa, which Fed speaker has your closest attention?
Well, it has to be Powell. Do no harm. What does that mean at this point when you have a question around whether the Fed has lost control over the long end of the yield curve? Do they just keep leaning into this message? It's doing the work for us. The more it bounces around like a ping pong ball, the more that we can step back and not raise again. Either way, I don't know how much we're actually going to get some sort of definitive statement from him other than his balance of risks right now.
Lisa, your thoughts here as we go into a Monday midday in Israel, your thoughts on all the news flow of the last literally 12 hours.
It's a fog, and it's unclear why there hasn't been an escalation the way that Israel had promised in terms of the ground invasion. It's unclear whether Iran and the discussions, the back-channel discussions that they had with the U.S. were successful. What is clear is that there is a feeling of high tensions and that this could potentially explode into a broader Mideast conflict that a lot of people would like to see avoided.
The markets do trade on a 10-year real yield now, elevated by 6 basis points, not out to new real yield highs, but John, 2.34% shows the cost there of capitalism right now.
For all that stress abroad, for all that tension in the Middle East, for the tragedy we've all seen disturbing pictures from, Tom. This equity market was up last week for a second week of gains on the S&P, up a third of 1% this morning, helped out by developments in the bond market, yields lower by almost 20 basis points on a 10-year last week, more than that on a 30-year last week. The 10-year this morning up by 9 basis points, Tom. Let's call it 470 on a 10-year this morning.
Just one item, John, 149.53 on dollar yen, really not breaking through to the tension of intervention or some process in Japan, but nevertheless not giving way to strong yen. We haven't seen that.
That's really not on our radar anymore, is it, Tom?
No,
still
it isn't.
In and
No,
around
well
150,
said.
though. We're still right there, 149.53.
A hugely popular guest, and I don't mean popular in terms of fun and games. I mean insight and intellect. Peter Cheer joins now, head of macro strategy at Academy Securities. Peter, you were on fire last time. It was just really brilliant about the dovetail of all these narratives. How has your narrative changed, say, in 10 days?
Well, we're all having to process what's going on with Israel, Hamas, and the Middle East. So that's probably been the biggest change. It's been clearly a very sensitive issue. We think it's playing out right now kind of as it should, that Israel will eventually, secure their borders. They will make sure that it is safe for their citizens, but they'll do it in such a way that it doesn't escalate this conflict beyond relatively small borders.
Localized, Pete, is that the word that comes up with clients again and again and again? Is there a belief that this can remain localized?
Yeah, I think that is the belief, and I think that's what the market is pricing in right now, and it's rightfully so. Israel certainly has the capacity to eliminate the threat. They said they will eliminate the threat, but I think it's very positive that they are doing this carefully and cautiously to minimize civilian casualties. The two risks kind of that aren't priced in is an escalation with Iran. It seems like we're trying to take some backdoor channels to keep that threat low, or that something spurs the change in sentiment in Saudi Arabia. Saudi Arabia has been making a ton of progress in terms of westernizing their economy, in terms of the Abraham Accords. So we're watching that very carefully, and that's probably the main reason Israel is being very cautious as well.
Pete, do you believe America has the capacity to support two military conflicts simultaneously?
We do, but as some of our generals, General Teptula has been very on top of this for a while. We have been underfunding parts of the military, so we're going to be a little bit stretched. Two fronts, I think, is fine. It does leave us a little bit vulnerable. We are going to have to see a massive replenishment of our weapons systems as we've been, providing weapons to Ukraine. It looks like we're going to help Israel in terms of refilling the Iron Dome weapons. So there's going to be a lot going on the defense side for the next years to come at this point.
When it comes to refilling all of these supplies, it does take money, and something we've been talking about. Is there an appetite to expand defense spending at a time where borrowing has gone up and interest payments are going up as well? How does that factor into your calculus at a time where a lot of people are not fully understanding some of the gyrations in the long end of the yield curve?
The one thing, so we've got the 18 retired generals, admirals, and 2 astronauts to get to work with. The unified message we get is that in terms of national security issues, DC is actually very bipartisan, very smart, right? You do not get to sit on these high-level national security committees unless you've demonstrated intelligence, bipartisanship. So I'm actually very comfortable that when we have these real threats, we will put together and do the right things. So there will be spending, it will be well done, and it's necessary, and we have to kind of reinstate our influence in the globe, which has been waning.
One thing that you do really well is you game out what is priced in and what isn't priced in. You said earlier that some sort of escalation with Iran is not being priced into the market. How would it be priced? How do you see it percolating out in the market? Should there be some sort of expansion in the region with either Iran's, some of its proxy fighters, or just the nation itself?
I think then you definitely see oil hit above 100, and there. More importantly, it wouldn't just be a short-term spike. I think you'd start seeing futures build out at a much higher price for a year or 2 years. And that had given us some comfort on some of these recent spikes. It was much more consolidated in the front end of the futures contract, not some of the longer-dated contracts. But if we really are going to impose sanctions on Iran, if they are going to potentially disrupt oil flow in the Middle East, that would have a much more serious impact. And I think the bond markets can kind of shake off what's currently going on, but that would probably push yields higher as we would be facing much higher oil prices for much longer.
Peter, within economics, finance, and investment, you are a student of history. Amid war, as a general rule, what do stocks do?
I think they get volatile and they're fluctuating when there's a lot of uncertainty. But once it looks like the path has come through, we generally tend to rally. I think we had that just recently with Russia and Ukraine. There's that initial fear factor. And then as people say, okay, this is what it looks like, this is how it's controlled, this is what we do about it, we can rally. And again, position was fairly light, I think, coming into this. So I'm not surprised that we can get a nice rally if we maintain the status quo and Saudi keeps making the right signals and Iran doesn't escalate this.
Yeah, I look at the catharsis required, and I'll let somebody else smarter than me determine if we've had bond catharsis, but I think we can certainly say we have not seen equity catharsis. Is that required?
We saw so much equity catharsis last time around, in the last year, so I'm not sure how much catharsis there is left to have. So it's hard to get super bullish, 4,500, 4,600 on the S&P seems tops, maybe 4,200 I think seems to be a bottom right now, unless something happens in the Middle East.
What are you hoping to hear from all of the Fed speakers? Do you think that they are that important at this point with such heightened uncertainty as we get the last gasp before the quiet period?
I think they're going to make it very clear that the data has not been consistently strong enough to hike, that they really don't want to hike. I like the fact that they're talking about real yields. We've been talking about that for a couple of months of how important that is. We are starting to see this filter into the economy. We're hearing more and more, I don't want to say horror stories, but stories of companies that were borrowing at 7% that are now facing 14% as their debt matures. So I think they're supposed to pause and let this play out, especially now with this global uncertainty.
Well, the global uncertainty is there, but then it's by straw hats and winter. What are you acquiring today? I mean, I'm assuming you're not 100% in cash, so what do you buy?
I like bonds again. We've been trying to rate range this as, we got to 480. You want to buy a lot of 10s. As you get back to 450, you sell some. Same on the stocks, right? It's kind of that range. As you start pushing towards 4,500, you want to be reducing risk on the S&P. As you get below 4,300, you want to be adding. So I think it's a trader's market, and you do want some hedges. My favorite hedges right now, I think, are buying calls on treasuries, because if we get this geopolitical escalation, although oil is going to go higher and Fed can't ignore it at the front end, I think the back end is going to start pricing in a true flight to safety trade.
Pete, how are you getting a read on the potential for escalation? If there's one particular voice you're following at the moment, whose voice is it?
There's not one particular voice. So we're searching around. And again, I've got the luxury that we've got 16 specifically generals and admirals who are retired who are talking to people across the U.S., across the world, to the IDF. So we're trying to distill this information that we get, and that's what we're trying to look for, these tiny little signals that aren't on the radar screen. So it's a little bit tricky, but I think we're trying to manage it pretty well.
Peter Chair, managing it very well. Thanks for being with us, sir, at the Canopy Securities. Pete, appreciate it as always, mate. Just to update you on the president's movements, the latest from the White House, the president's trip to Colorado was scheduled for today, postponed, will be rescheduled. The president will remain at the White House to participate in national security meetings. If you are just joining us, welcome to the program. Plenty of movement in this bond market over the last couple of weeks, that's for sure. Over the last 5 weeks, we saw yields higher. Last week, finally lower on a 10-year, on a 30-year by something like 20 basis points across the board. On a 10-year this morning, higher again by 8 basis points, so try and keep up. 469.56. Crude just nudging higher by 0.2%. Worth a look, given what we just talked about with Pete, 87.88 on WTI, 87.85. And if you are just joining us, the equity market on the S&P, positive by 0.25%. Plenty of earnings still to come. Economic data, Fed speak, tons of that. Chairman Powell on Thursday. Julia Coronado of Macro Policy Perspectives, 8:30 Eastern Time. We'll catch up with Julia Tom in about 18 minutes' time.
I think it'll be fascinating to see what she says about the choice side. And frankly, I want to get, Lisa mentioned there's 14 Fed speakers today. Julia should be one of them. And the answer is, how do they message this within war? And they've got to be saying they have less confidence in their guesstimates. To me, that's the heart of the matter.
Well, the idea of uncertainty being a policy is kind of where we're at. What Peter Scheer just said there, though, is really interesting, and it's something that we heard maybe from Jay Pulaski as well, which is treasuries are still a haven trade. And it's unclear whether we're seeing that play into all of this, but when there is uncertainty, at some point, the buying will start to come back in. And we keep hearing that from a number of different guests. But have we seen that? I mean, this is sort of a question. Would we see even higher yields this week, last week, if it weren't for some of that uncertainty hanging over markets?
Would you like to go through the Fed speak for the next couple of days?
I'd actually be dying to. Please, help us out.
Harker, Williams, Bowman, Barkin, Kashkari, Waller, Williams, Bowman, Barkin, Beige Book, Harker, Cook. That gets you through Wednesday. And then you go on to Jefferson, Powell. This is ridiculous. Goolsby, Barr, Bostic, Harker, Logan into the quiet period that starts this weekend.
When is a quiet period? It can't come
Saturday,
soon
I
enough.
believe. I believe it kicks
3
off this
p.m. this
weekend.
afternoon.
I have to say, that was gold. Harker.
Oh, killing me.
I said Beige Book.
It's ridiculous. He'll be reading the Beige Book, you know that, Bramley.
Oh, yeah.
Terry Haynes of Pangea Policy on the
Kindle
dysfunction
version.
domestically here in the United States, facing the prospect of escalation internationally. Your equity market positive by 0.25% on the S&P. From New York, good morning.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
From New York City,
From London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
We say this to the Israeli people. We have your back. We feel your pain. We ache with you. And we and our country will stand by you in these difficult times. And I, along with my colleagues here, will lead the effort in the United States Senate to provide Israel with the support required to fully defend itself from this monstrous attack.
The Senate Majority Leader Chuck Schumer there speaking in Tel Aviv over the weekend. From New York City this morning, good morning and welcome to the program. Your S&P 500 is positive on the S&P, inching higher by 0.25%. Yields are much higher again by 8 basis points, 469.56. The Nasdaq doing okay, even with a move lower on Apple. Check out Apple in the pre-market, just a bit softer this morning, down by something like 0.8%, 0.81% lower. Apple's new iPhone 15 selling far worse in China according to some research, sales of Apple's flagship device down 4.5% compared with the iPhone 14 over the first 17 days after release. This according to market tracker Counterpoint Research, their estimates and previously unreported figures provided to us here at Bloomberg News. Tom, the stock a little softer, down by 0.75%.
That article out of our Asian platform, not Mark Gurman. I, of course, emailed Mark Gurman to get his view on this. He is absolutely authoritative on all things Apple. We'll have to see. But it's clearly a very discreet statement on counting of phones.
If it's true, if it's real, if it's the reality of things and where we'll end up in the quarter, is that because of sluggish consumer spending in China or because of competition? Which one is it?
I think competition was in the article. I don't know. I'm just not qualified at that. But this is the kind of angst you've got on Apple. It's exactly the same angst 6 crises ago on Apple.
Analysts over at Jefferies, Tom, sort of echoing this as well. Reckon sales of the iPhone 15 were down by an even sharper double-digit percentage from its predecessor after Huawei unveiled this new beast over in China.
We've got 8 ways to go here now, John, and we're going to do this with Terrence Haynes, founder of Pangea Policy. He's been of huge value of how Inside the Beltway is amending to what he calls geopolitical risk at a half-century high. That is a sobering statement, to say the least. Terrence, I don't even know where to begin this morning. I guess I'll begin with the immediacy of a president considering going to Israel. LBJ really didn't do that in Vietnam. Pick your other presidents along the way. What is new about this new prosecution of war?
Well, there's a lot of personal diplomacy involved here, and one of the things the White House is considering almost certainly is that the president's presence in Israel might help that to happen. There's that on the one side. On the other side, the president was interviewed on 60 Minutes last night from a Thursday taping. And we were told by CBS not once but twice how tired he looked or seemed. And so on the other hand, you got to understand that the president needs to conserve his own energies. And that might be best done in Washington.
From where you sit, does the president have the support of some form of our legislative branch? Or are things so fractured that it's an executive branch alone?
No, I think there's a good deal of support. The difficulty is that one of the things Biden wants to do this week is send up a combined aid package for both Israel and Ukraine. I think that fractures on the factions in both parties that I talk about frequently. And number one, so it really makes it more difficult. Secondly, you're going to see a rare public prosecution of the administration's Middle East strategy and Iran strategy directly when Jack Lew goes up before the Senate on Wednesday for a confirmation hearing. And I think his nomination right now is in some peril. But we're going to have a full-throated discussion and debate about this in public, which is rare, but probably good for the American public and for Biden.
Can you elaborate on that, Terry? I mean, a lot of people are wondering whether dysfunction in Washington, D.C. limits the U.S.'s ability to respond to a crisis that you think has the potential to be the worst that we have seen in 50 years of geopolitics. How much do some of these internecine fights threaten the U.S.'s ability to adequately respond?
I think less than is bandied about by newfound experts on House process and procedure. Bottom line is that the speaker, the temporary speaker, can do, according to House rules, can use whatever powers are necessary of the speakers. There's a choice being made here, basically by both parties, that until a new speaker is established, they don't want to test that. But if we had an emergency, say the need to provide immediately for Israel Israel immediately in Ukraine, or even activate our own war powers, almost certainly the House would be able to do that and do it very quickly. So I wouldn't, honestly, I wouldn't worry about that.
We have been talking about how the U.S. will keep probably spending, that there isn't a lot of appetite in D.C. for restraint at a time of a number of different conflicts and just domestic concerns. How much are we seeing, from your vantage point, a doubling down on that with respect to additional international aid and restockpiling of weapons in the U.S.?
Well, I think in the end, you're going to get both an Israel aid package and a Ukraine aid package. I do think that takes probably another couple of months, though. As I've said to markets, and I think I've said on this program, the fail-safe really is the end of the calendar year, because that's when the regular defense spending and defense authorization, kind of think of it as priorities, legislation finishes. Until you get to that point, there's no real forcing event that requires anybody to make a decision, whether it be on domestic spending or on aid packages.
Terry, to the war in the House of Representatives, I'm trying to find a history analog here, and I can't get there. The Democrats maybe are going to help out centrist Republicans. What's their key ask?
The Democrats, I don't know. They haven't said, and I suspect they don't want to say. What they are saying is, well, gee, we could band together with the temporary Speaker McHenry to expand some of those powers. The difficulty here is that Republicans want to come together around a speaker. McHenry thinks of his role as purely ministerial until the time comes to elect that new speaker. And as I told markets yesterday, I think what ends up happening is Jordan doesn't make it, and the best compromise candidate will be arrived at, and that's probably McHenry, something he doesn't want but is going to get thrust upon him, I suspect.
Terry, you nailed it last week. I think we've got to repeat that. Last Sunday, waking up Monday morning to the massacre that took place in Israel, there was a sense that we could maybe address the dysfunction down in Washington, that perhaps we'd increase the odds of getting a speaker, reduce the odds of seeing a shutdown. You said those people are wrong. Terry, that ain't going to happen. Just on the shutdown, in any way, shape or form. Terry, does it reduce the likelihood of a government shutdown, given the aid that some of these places need?
I think not today, but we're a month away from that. I think the aid packages are going to be hotly debated. We'll make some accommodation for that. But initially, and the White House has said this, by the way, so it's not just me. Initially, there are lots of things they can do without needing additional kind of formal congressional legislation, particularly on Israel. I mean, we've already got 2 carrier groups over there, so and of course they're going to be supplied and whatnot. But those aid packages are going to go through in the succeeding weeks. But the dynamic, the imperative hasn't really changed in Washington, and I think what you'll see is the House stumble through another week before coming up with a compromise candidate.
A nice bath for the happy talk in Washington over the past week or so. Terry, thank you, sir, as always. Terry Haynes there of Pangaea Policy.
He's just so well attuned to politics. Whatever you think of his angle in politics and all that, just there it is, the word compromise. How quaint. How ancient.
Let's see if we can get one of those.
Yeah.
In the next hour on Bloomberg TV, here's the lineup just to get you set up for the trading week. Tons going on, lots of earnings, lots of economic data, tons of Fed speak as well. We'll do that with Jim Karen of Morgan Stanley, Mira Pandit of JP Morgan, David Bianco of DWS, and to get you set, prepared, ready for the bank earnings over the next 48 hours, Jason Goldberg, Tom, out of Barclays.
Yes, the bank earnings to me are fascinating, and I'm really attuned, John, to the conference calls, and do they say we need to wait another 90 days to really understand mark-to-market dynamics versus bond price
Particularly for the likes of Bank of America, where there seems to be a big focus on that in the market. From New York City this morning, this is Bloomberg.
for the first, call it 18 years of Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg surveillance of the markets on the move. Equities, bonds, currencies, commodities, and the commodity of note is oil. Lisa Abramowitz, Brent crude just spiking. That overstates it. Let's call it a lift above $91 a barrel, $91.34. That's a high in the last number of days.
And it comes after Friday's move, I believe, on Brent of 5.7%. So a real pop there. People feeling out the situation, some tit for tat going on, rhetoric that's hard to understand. Again, parsing through some of the chest thumping, how far are diplomatic efforts really getting? And we don't really have a sense this morning.
Well, we don't, and we'll look at the news flow as we can. And again, balance of power this evening. Joe Matthew, Anne-Marie Horton, and team will give you the latest of Washington. Right now, with the green on the screen, I've got futures up 11. I got a VIX under 19, so it's a more constructive volatility index, 18.85, 210 spread. I got a lift of 6 basis points. I'm watching the real yield, not as real as it was a few moments ago, 2.31%, but that gives you a sense of the character of the market. Dollar fractional weakness. There's nothing ever weak in the analysis of Michael McKee, our Bloomberg International Economics and Policy correspondent. He and I watched together the Jets' big victory yesterday, which was a nice relief from all this news flow. And what we're seeing, and the heart of it is, we try to get a pulse of an American economy that seems resilient. Are we going to see a resilient retail report tomorrow?
In essence, the feeling is we will see a solid, if not resilient, report. A little bit slower than it has been, but still Americans are spending money. We just got the Empire manufacturing numbers in, and while the headline number goes down to negative 4.6 from 1.9, we saw prices paid fall, prices received fall, number of employees go up, and the work week lengthen. So there's still a mixed picture out there, even though the headline for Empire Manufacturing, the New York State area, is not great. The underlying details suggest there is, to use Tom's word, resilience.
Right. Well, this is sort of the question as we sort of ask again and again this morning why the long end of the yield curve has experienced such a spike upward. How much of this is actually due to inflationary pressures that might have been underestimated in their stickiness? What are you seeing in terms of the specifics, the amount of savings that consumers still have left over that maybe we'll get a sense of tomorrow?
Well, we keep hearing that consumers have spent down most of their pandemic savings, except for those in the higher income categories who didn't need it to begin with and don't spend everything that they get. So their marginal propensity to consume, as economists say, is not as great. But Americans still seem willing to spend what they earn, and they're still earning at this point a little bit more than inflation. So that's it could keep us going for a while.
You may have noticed that the couple Fed speakers are speaking this week. I know that Tom is very, very concerned about that. I personally kind of enjoy hearing the nuances that they come out with. From your vantage point, what do you think will be most interesting interesting to learn? What is the unknown that they could illuminate at a time of myriad unknowns?
It's something that they won't illuminate. There are 14 speakers this week, 20 speeches, and if you like Pat Harker, he's speaking 5 times this week. But the question out there for everybody is not so much whether they raise rates another quarter point or not, but it's how long is long for keeping rates higher. How far into 2024 do they think they have to go? And I don't think anybody's going to want to say that because they don't know. But obviously the highlight of the week on Thursday, Jay Powell sitting down with our David Weston, and hopefully David will say, we're not letting you go until you tell us.
Let's stop the show right now. How did we get here? I get the idea that when abroad, one of the 12 districts of the Fed, you've got to go out and see the Rotary. You know, you got to go see the Rotary in Fargo or the Rotary here, the Rotary there. But how did we get, Mike, to this frenzy of communication?
Well, each individual bank president wants to communicate in their district, and they get tons of invitations. And I think it's just built on itself. They've spoken to the Rotary in Fargo, so they need to go speak to the Rotary in Williston.
Did we used to pay attention to this when you were covering Arthur Burns?
Well, no. And you didn't see Fed officials speak very much, especially governors. And now you do see all of this Fed speak, which all of the financial news media cover. And so it becomes this big thing. We hadn't had that really before. We were always there for their speeches, but the more we cover it, the more it becomes a central issue for the American people, the more Fed officials feel obligated to explain where they are. Now, Saturday is the great holiday. It's the start of the Fed blackout period.
That's the best news I've heard today.
They're all trying to get in before the deadline.
Right.
So,
Michael McKee, thank you for that brief here on economic data. Again, we'll have complete coverage of retail sales tomorrow. Right now, Julia Coronado, president and founder of Macro Policy Perspectives, joins us. Julia, I don't know where to begin between Fed speak and the rest of it. How do you define right now your view of higher for longer?
Well, I think that's where we are in this phase. This is the phase of policy we're in. So we're slowly moving away from do we need to raise rates another time or not to how long do we need to hold here. And that in and of itself is applying some pressure. I mean, I would attribute some of the last jump in real yields to the realization or the capitulation to higher for longer. And that will in turn take its toll on the U.S. economy. We've seen mortgage applications roll over and builder sentiment sour a bit. So we have another leg of tightening coming through. And I think that's what we've heard from Fed speak is that they didn't necessarily expect that latest jump in real yields and longer term yields. Now that it's with us and it's staying with us, they're going to want to see how that in turn does their work for them and sort of be a little patient here, hold their fire at least till December and see how things play out. But the threat of another hike will remain with us as long as we're approaching inflation from so far above their target.
Julia, I'd love your insight on the snark that we portray regularly on the massive Fed speakers and whether it's a good thing or a bad thing that we have such incredible communication. What's your view and kind of how is this sort of framed in your mind?
So ultimately, I think this was a policy choice, right? They had made a decision starting with the Bernanke Fed to pivot towards more transparency. That came with forecasts in the summary of economic projections and the lovely dot plot that I'm sure Tom loves so much, and a lot of Fed speak, forward guidance on rates, et cetera. So all of this transparency, I think, was a reaction to the sense that the American public had no idea what the Fed did. And yet they were incredibly powerful. And I think there was a sense, even before the global financial crisis, but particularly after, that sort of the Fed owes it to the American public to be as transparent as possible. And what that means is what feels like at times a cacophony of voices. But I think that's better than the alternative of the sort of secret temple making all these powerful decisions over our lives.
There's also a question about the ability of the Fed to remain independent politically. And I say this at a time where they will always say they are, and yet the fiscal deficit is getting bigger and bigger. And one of the big instruments to keep yields low has been the balance sheet. There was some discussion last week about the potential for the Fed to deploy the balance sheet or do some kind of yield curve control, as Michael Schowell of Market Field said, if there is this feeling of uncontrollable action at the long end. Do you see that as something that politically they could afford to do?
I think the bar is very high to doing something like that. And based on what we're hearing from Fed officials, they really are quite committed to running that balance sheet down. I think the Fed is uncomfortable with this sort of negative earnings position they're in. And while, they're not panicking, I think they really, really are committed to bringing that balance sheet down. So they have shown a great reluctance to turn to sort of small tweaks to balance sheet policy that they could implement to address concerns about banking liquidity or the yield curve. So far, I think the bar is very high to that.
Julia, I'm absolutely fascinated by their constraints, their lack of degrees of freedom because of a new higher real rate regime. And I guess the nice way to put this is there inflation-adjusted yield policy constraint? Do they simply begin to have less wiggle room?
Oh, I think absolutely they have less wiggle room than they did before. Again, partly because we are approaching their inflation target from above, not below, like last cycle. And so that in and of itself is a constraint that ties their hands. If we have a wobble in the economy, they're going to be a lot slower to turn to policy easing than they were in previous cycles, because they really need to see that the inflation beast has been slain. And I think we've gotten a lot of good inflation news in the last few months, but we're not there yet.
Okay, so Lagarde comes out at the panel I did in Morocco and says, with quite force, we're going to get back to 2%. Amateurs like me read that as 2.0. Does a pro like you read that as 2.9?
No, I think that they can and will get at least a lot closer to 2%. I think we need to be well under 3% before the Fed were to consider, again, pivoting on policy towards actual easing. We think that that's possible, especially if rent finally starts cooling. It didn't in the last CPI, but no, I don't think that they're going to back off quickly. I think we haven't heard anything. In fact, Chair Powell quite decisively has batted down any notion that they would contemplate a higher inflation target decisively and unequivocally. So I don't think that is on the front burner anytime soon.
Julia Coronado, Dr. Coronado, thank you so much. Macro Policy Perspectives in advance of David Weston's conversation with the chairman of the Federal Reserve. Look for that Thursday. I'm looking at Brent crude 91.24, up 35 cents, 0.4%, but 91 is not $89 a barrel. Equities lift, futures up 20. The VIX comes in 18.58 from a 19 level. What, Lisa, are you looking at?
Well, I'm watching crude, obviously. I'm also just watching the ping-pong action that you've seen in the bond market at the long end, the 10-year and the 30-year yields.
That's the right way to put it.
And how much they just have been bouncing, and the new normal, as John was saying, is 10 basis points rather than 3. It makes a big difference. And I do wonder at what point, George Concalves of Deutsche Bank earlier this morning saying that, or Mizuho, excuse me, could say that you basically have corporations that can't really survive in the same kind of way, and that Rite Aid is the tip of the iceberg in terms of normalizing to a 4 to 5% benchmark treasury yield.
Maybe as the mother of all zombies, as the Rite Aid's had a checkered life about it, but it is the great zombie roll-up. And I'm telling you, this real yield at 2.30%, I find to be extraordinary. Futures up 20. The Standard & Poor's futures now up 0.5%.
Right now, we are looking forward to a conversation with Stephen Major, to a discussion that you've been having about price down, that it's not just a yield issue of yield up. And to me, this really is going to be the question. Are we seeing the bond bulls capitulate in a year of incredible bearishness.
Without a question, the number one conversation of the day here on bonds, and what I would say, Lisa, that's so important here is Steve Major looks at the microeconomic supply-demand flows that make up the yield curve. He doesn't just partition it into Fibonacci 101. He's really looking at the emotion, and that gets into catharsis here, where you get to a lower yield, price up, lower yield.
And trying to understand why we haven't seen it yet. And really, right now, one of the bigger questions is, of everything that we're hearing about in the Middle East, and we have heard guest after guest say that this is a callous market, it is a cold-hearted market, it is a market that looks past the human tragedy and suffering and just, how does this affect me? And right now, people aren't seeing it. But if there is an escalation, that you will see that flight to safety, and that will be expressed in treasuries. And that's what we heard from Peter Shear.
I'm going to take it just simply down to Brent crude here at a 91 level, and you say, well, how does that advance up to something of angst for all world leaders? And the answer is Suez Canal, which is X number of miles from the southern tip of the Gaza Strip. To me, that's maybe the single geopolitical issue that folds into our worlds as well.
Well, and what the unknowns, right, at this point, given the flexibility to potentially respond to that, given where we are fiscally, and given the appetite or not to do things.
Please stay with us. Without question, our fixed income interview of the day, Stephen Major of Hong Kong and HSBC will join us as well. Futures up 19. This is Bloomberg on radio and on television. Good morning.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the US and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
The market says there's over a third probability that one of the two meetings is live. I hope it's not. I really hope it's not. But you know that I say that because not only do I worry about the lagged effects and the financial stability and growth effects, but I also do think there's a danger in trying to get to 2% too quickly.
Mohamed El-Arian, Bloomberg opinion columnist last week with Jonathan Farrow, parsing through how to understand the inflationary environment at a time where the Fed is determined to get back down to 2%. Right now, we can see markets trying to grapple with this as well, as though you are seeing a sort of pinned expectation on the front end of about 5%. And yet the fluctuations continue at the long end with 10-year yields, Tom, up now just 7 basis points, only a sole 7 basis points after we've seen an incredible amount of volatility over the past few weeks.
I eyeballed the Lisa Abramowitz index, also called the MOVE index, because she moves 10 miles a day on her race back home after the show. And I'm looking at the Merrill Lynch MOVE index, and I guess about all I can say intelligent is we're not to the massive catharsis of 07, 08, 09, excuse me, But boy, we're right there. I mean, on a smooth moving average, I was like, oh, gives pause.
Yeah, this idea of expectation of volatility continuing. Meanwhile, you aren't seeing as much action, ironically, in assets perceived as riskier. I do want to just point to a couple of names that stick out to us. We did talk about Apple earlier and how an independent report highlighted not that much, down about 0.5% off this idea that maybe smartphone sales, the latest edition over in China, are not selling as quickly as they have previously. Stellantis shares, I thought was interesting to point out, down 0.8% after just the sense on Friday. We didn't even talk about this. The strikes are ongoing. They are still ongoing for the auto manufacturers, which I think is important to keep mentioning at a time. We heard from Sean Fain Friday, and he basically said, we can strike at any time. We're at that point in our negotiations.
Well, thank you so much for bringing this up, because there's a lot of other news. We're focused on the president's change in schedule. He was Colorado bound, and he's going to know I'm going to sit at the White House and look at this geopolitical mess that we're in. But there's all these other stories going on. We're committed, folks, to keeping as best we can up to touch with them.
Just real quick, though, to build on the geopolitical story, and I want to end with really the first story, which is Shell shares reaching a new record high.
Yeah.
And this comes on the heels of expectations of oil to increase, but also a renewed focus in this company on oil, not on renewables, not on moving away. And are we going to keep hearing that more and more, especially with the geopolitics?
Really interesting in Morocco to see the IMF not distance themselves, that's too harsh, but to see the IMF move away from that. What's really great about this is our next guest, Lisa, I said to him, I said, you know, what do you think? He says, I'm not coming on again until the tots are in first place. So, you know, it's worked out well.
Well, fantastic. Congratulations. Stephen Major, Global Head of Fixed Income Research at HSBC. And really, I am so glad to speak with you. We're at a time of an incredible bond bear market. Yeah. You've been bullish. How can you reaffirm that at a time where we don't really understand why the sell-off has been so severe?
Yeah, there's been a capitulation. So there'll be people like me, but people with skin in the game, people who are actually long of bonds, who have had to cut the position. That could be for risk management considerations. It could be because clients are taking their money out and they're having to respond to that. So I think there's a capitulation. There's evidence of capitulation in the way the term premium moved. So it's the back end that's where the action is. And I think there's a lot more safety in the front end right now. You can see twos are behaving differently. Maybe for the first time this year, twos have become safe. And I think the mantra has been don't touch the twos all year, because you would have been going against the Fed. If the Fed's done now, more or less, then you're fairly safe entering twos. And that's how the bond market can start to perform better. Money will creep up from the front. That's why people are leaving the back end alone at the moment.
There's a lot there to unpack.
Yeah.
I just want to go to the whole capitulation story.
Yeah.
You said there are signs of capitulation. Where? Who is selling so aggressively at a time when a lot of people are saying it's a buyer strike?
Yeah, I think it's probably real money. And there's this game in fixed income about discussing the marginal buyer and seller. The truth is you never know till afterwards. Right? The bond market is fairly sophisticated, but you don't know the buyers until after it happened. You can see the supply coming because it's published, but you don't know who actually bought. There's a lot of gaming of who's going to buy, right? It seems to me the marginal buyer has to be domestic, so it has to be here in the US, because the official sector overseas is not sponsoring the market as it was before. The private sector isn't picking up enough, so it has to be inside here. Now, 70% of treasuries are held in the US. Of course, the Fed's a big part of that, but the story is it has to be here. It's probably not the banks. Real money has already taken long positions and may be adjusting, so it has to go into retail. It has to go to small investors. It has to go to those who are in equities, so big investors on a multi-asset basis. So people coming out of stocks into bonds, people going from cash into bonds. That's where the marginal buyer is.
The great fear here, Steve Major, is what I call the Whalen silence. Chris Whalen, with his wonderful one volume of America Financial History, where in the bond market, you're trying to do something, and all of a sudden on the other end of the phone, whether it's the 18th, 19th, 20th century, there's silence. Are we anywhere near that?
Yeah, well, that's a really good point, because it does seem that there's been a bit of a buyer's strike. And so the evidence for that is in the auctions. You look at the cover ratios, so how many people showed up to buy the bonds at the auction. There's less there, especially in the long end, the 10 and the 30-year paper. But it gets to the point where the value is just too too obvious. You've mentioned real yield several times on the show, when the real yield is comfortably above the trend GDP rate, the actual trend GDP and the projected trend GDP, then you're pretty covered. So the inflation piece is locked when the real yield is above the trend GDP. You're not going to go too far wrong. Now, I'm not saying that today it's free money. It's just that you'll look back in 6 months' time and you should be happy with the investment you made today.
700 pages at the IMF, the blue book, the green book, the red book. Georgieva says she's going to print a copy just for me so I can read it. The one appendix I read was Tobias Adrian, fiscal instability, liquidity and solvency. Does Steve Major have liquidity and solvency issues as written in his appendix?
Forget the solvency. The US is going to pay its bonds. The idea that you have a ratings issue and that ratings explain the yield shift.
So what about liquidity?
Liquidity, now this is the price of getting stuff done in plain English, right? That's what liquidity is. When the market is illiquid, it's more difficult to get a big trade done. So you have to pay a bigger bid-offer spread. That's my simplistic, plain English explanation. There is a liquidity issue right now because the banks aren't prepared to hold big inventory. The intermediaries are just not there. And liquidity and risk premium tend to move together. So if we have an illiquid market, then the risk premium goes up, and that's your term premium and the higher yield in the long end. That's what's happening right now. I look back at this, and I think you've got record moves in the term premium, even back to 2013. And don't forget the context is important here, Tom and Lisa. Back in 2013, the taper tantrum was like the main thing that happened. Now you've had a 2-year bear market going into a 3-year bear market, so rates moved up a lot. Then the term premium going into a 3-year bear market, so rates moved up a lot, then the term premium flipped. You didn't have that back in 2013. So you really are entering a good level of yield at the moment.
Given the fact that you think that we're at a good level of yield, how do you sort of lean into the front end and not the back end, right? Why aren't you just going all in on the 10-year?
Let me be absolutely clear. I think that investors who want to buy bonds for the first time, who are rather shy, can creep into the 2 years out of a money market product, and they're not going to lose a lot of money, if any. You're safe in the 2. So if you're shy and you're going into bonds for the first time, you're safe in 2s. Then you creep up to 3s. Right. Now, for me, if I'm making a call for the next 6 months, of course I buy 10s or 30s, because I'm going to look back in 6 months' time and think that the yield's fallen 100 basis points.
Where's it going, though, at the end of the year?
Well, our forecast is 3.5. We're running out of weeks and months, of course, but 3.5 could be the right number in 6 months' time. So I don't think we've got the directional call wrong here. I think yields will be lower. It's just that maybe our timing could be off.
Yeah, it's the same as like guessing if West Ham's going to do well or not. We're running out of time. Steve Major, one final question to real. Joyce Chang, J.P. Morgan, on stage in Morocco, said she's modeling out a 2.5% inflation-adjusted yield. That took me back. That seeming was elevated. Take your nominal lower yield call and squeeze it into a real rate call.
Yeah, so the 2% inflation is locked. If there's one thing that's come through all of this is that inflation targeting is credible. The 2% inflation has not been challenged in the break-even forwards. So for me, it's all about real yield. 2.5 is just way above trend. Therefore, we can take 100 basis points off of that. You know, I think that a fairer level for the real yield would be 1.5, not the 2.5 that we're trading at the moment. And by the way, that would still be above 100 over the Fed's R-star measures. So you people are saying that the real rate needs to be higher. Well, it's priced as a lot higher.
We got to go. Stephen Major joining us with the Hong Kong Shanghai Banking Corporation tonight. Please stay tuned to all of our reporting from Washington. Balance of Power with Representative Stevens of Michigan.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything. Venture capital. It's been volatile. From Bank crisis anxiety to AI exuberance. Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Started live from New York City this morning. Good morning, good morning. Your equity market with a lift on the S&P positive by 0.5%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
From New York, coming up, President Biden considering a visit to Israel. As the U.S. plans to tighten China's access to chips, investors mulling a week full of corporate earnings. We begin with the big issue, whipsawed by bonds.
A lot of this is whipsawed.
We've been watching these rise in bond yields.
What we're seeing is this enormous volatility.
We're just going into a more volatile world.
We have lost all anchors to the bond market, all of them.
It's not just been the bond volatility of the last 7 days. It's really been the bond volatility of the last 3 months.
The economic anchor, we have lost a technical anchor, and we've lost a policy anchor.
The rise in the long end yields, if anything, was doing the Fed's job.
The Fed is probably done raising interest rates because they realize that the bond market's been recently doing all the heavy lifting.
What level of of rates and financial conditions, do we really need here?
The bond market is looking ahead and figuring out that the Fed indeed is getting it right.
The economy does not weaken, then the path of least resistance for yields is higher.
Joining us now to discuss, JP Morgan's Mira Pandit, Morgan Stanley's Jim Caron. Let's get to you first, Mira. What kind of cue can you take from this crazy bond market action over the last few months?
If it can go wrong, it has gone wrong in the bond market this year, between some upside growth surprises we saw over the summer to a lack of full supply absorption with all the supply coming in online across the curve, And now, of course, there's a lot of federal finances concerns in the long run, so some real existential threats. I think perhaps the only thing that perhaps has not gone wrong is that we haven't seen a meaningful acceleration in inflation, so that has helped to somewhat keep a lid on the Treasury market. But otherwise, we have just seen instance after instance of headwinds for yields from here. Now, in terms of where we go, yes, we could go a little bit higher from where we are here, but as you start to see growth slow, because we're probably at that high water mark for growth, as you start to see inflation gradually come down, it should cause some relief for yields, but we're not going to see a cratering in yields either. There's really a limit to how much yields can come down over the next 6 to 12 months.
Jim Carron, does it tell you anything about what you should do with stocks?
Well, it's kind of interesting right now because, what it's really saying is that we've had this capitulation in the bond market where one of the most overcrowded trades this year has seen this significant rise in yields. And this repricing has been necessary over the last 6 to 8 weeks. What it tells me about stocks, though, is that finally at these levels, you may actually why I think that this might be an interesting time to start closing that underweight or starting to buy bonds.
Jim, interesting words you're using there. Starting to, closing an underweight. I don't hear get long, get overweight. What's the difference here?
Right. You're picking up on a very good point. We're not advocating getting long. All we're advocating is getting closer to your neutral target of duration. So if you look at index level duration for fixed income, it's somewhere around 6 years of duration. We've been running our duration around 3. We're starting to bring that up towards 4 or even 5 years of duration. So the difference between getting long is that we expect there to be a movement down in yields that's going to generate strong performance. Really what I'm saying is I think we're in a range. So, and there is risk, as Mira was saying, there is risk that yields.
Hello again, guys. Sorry, looks like Mike
look at last week's CPI
didn't work. Like I said, we closed our contract right now on euro against United States dollar, and we made 500 pounds. This is what I wanted to say. But it's looked like it didn't work. Something was wrong with my mic. We will buy, what I wanted to say, quite important, that we were going to buy at lower level. So I still, our indicators telling me that it's time to buy euro. It's all basically about at what level. So we try to buy at the lower level. All of you guys who followed my trades, well done. We made a profit. We made 500 pounds. In your case, it's all about how much you paid to your broker. I'll speak to you later, guys. Stay safe.
Even if over the course of the next year, you see rates fall by about 1%, which I don't think is entirely unreasonable, you could be looking at a total return of 11 to 12% on aggregate bonds if you add in that income component. So that's not bad for investors who have been experiencing multiple years of a really challenging bond market.
If you aren't familiar with the Fed's position, get ready for the next couple of days. Harker, Williams, Bowman, Barkin, Kashgari, Waller, Williams, Bowman, Barkin, Beigberg, Harker, Cook. Mike McKee, that's just through Wednesday. Then on Thursday, we've got Chairman Powell. Mike, what are we looking for going into the quiet period?
Well, it's going to be a crazy week, both with economic indicators and with Fed speak. And you mentioned Pat Harker. If you like Pat Harker, he's speaking 5 times this week. You should know what he thinks by Friday. Let's look at the economic data first. We had Empire this morning. Interesting number because while the overall number went down, prices paid and prices received went down while employment went up. who knows what that percentage is for the future. Tuesday, here's something that both Mira and James might be interested in. The tick treasury flows, they're for August, but they will give us another idea of who's buying and who is not buying at a time when the Treasury needs all the buyers they can get. Jobless claims on Thursday. We'll see if that has any kind of relationship to the UAW strike. But it is the Fed speak that everybody's going to worry about it. I don't have to read off the names because John just did, but there are an awful lot of people speaking, 14 different speakers, 20 different speeches. But the highlight will be Thursday, Jay Powell sitting down with our David Weston at the Economic Club of New York, and they'll be talking about, hopefully, how long is long when you're going to have higher for longer. And I don't think after the week is over, we will really have a clue, but we might get somewhere. Here's an interesting chart, guys, and I throw this up because this is what we're going to want to see the change in by Friday after all this talk, but it really shows you what the issues are for people trying to invest in bonds right now. The blue line at the bottom is where the yield curve was a month ago. The yellow line at the top is where the yield curve was 1 week ago today. And then the white line is where we are today. A lot of movement there. And which way do we go from there? That's the hardest thing to predict, given all this Fed speak out there and all of the geopolitical issues that we face.
That bear steepener has been phenomenal to witness over the previous few weeks. Mike McKee, thank you, sir. Yields lower last week, even with a 20 basis point move higher at one point on a 30-year Treasury off the back of a soft auction. Get your head around that. But that was the bond market action of the past week or so. Mira, let's talk about the Federal Reserve. The Fed seems to be happy to allow the long end of the bond market to do the work for them. Does that put a lid on the front end?
You know, it really depends what the Fed does next, because on the one hand, we've been hearing from a number of speakers more dovish comments about wanting to wrap up the end of the hiking cycle and not necessarily seeing further hikes necessary because we've seen a rise in yields and a tightening in financial conditions. But on the other hand, it was not so long ago, it was just about a month ago, that the majority of FOMC participants saw one more rate hike this year. So I think we can't rule out that we see one last hike this year. I don't think it's necessary given the yield moves that we have seen, but it's still on the table. And if we do see it, I'd rather see it in November so that we can get a little bit of clarity into the end of the year, as opposed to waiting for December, because that will continue to prolong some of the uncertainty in the bond market. And if we can have even just one factor that reduces some of the volatility we're seeing in rates, that would be enormously helpful for investors, even if rates stay elevated.
Short rates. Can we contain the volatility of short rates? Jim, I think this is so important. Let's go through the curve together. 2-year, 10-year, 30-year. 2-year right now feels like it's pinned by policymakers unwilling to step in, even if data's stronger, and to allow the long end of the bond market to do the work. The 10 years up by 8 basis points again today, 30 years up by 10. Jim, you've got all this flexibility now in the long end of the curve. The Fed's outsourcing policy to long rates. Jim, that's a change. How important is that change to shift the emphasis from short rates, Fed funds, to allowing the long end of the bond market to do the heavy lifting?
I think this is a big change, and we're seeing it right now. You know, effectively, when we look at financial conditions and when we look at where back-end rates are, you know, whenever I look at, you know, what the forecast of the 10-year note should be, the first place I start is what should the shape of the yield curve be in 6 months' time and in 12 months' time. The curve is still inverted, right? If we look at a 2s to 10s curve, it's still, 10-year yields are still below 2-year yields. At some point, those 10-year yields are going to be above those 2-year yields. The curve is going to re-steepen and it's going to get its shape back. The question is, do we have that as rates are going down, or do we have that as rates are going up? I would argue that we have that if rates are going down. And effectively what that means is that if we have a slowing in the economy, if we have a mild recession, I think that people will start to price in these, you know, these rate cuts, that many are doing. But effectively, the back end of the curve can stay relatively stable around these levels as the front end then starts to come down in yield. Now, essentially, that's not happening right now. Right now, as you were saying, it's all about back end yields moving higher. What that's doing is it's all term premium, it's all risk premium that's being placed into the curve. What that does is it creates a tightening of financial conditions. I mean, you know, where do you get your home mortgage loan? Where do you get your car loan? It's not at the 3-month rate. It's at the 5-year, or it's at the 10-year point, or even longer than that. So this rise in back-end yields does create a tightening of financial conditions, and I do think it does some of the work for the Fed. But ultimately, we need to see wages, we need to see the economy and inflation start to cool in order for this to really take effect and slow the economy to the Fed's liking. I don't think we're there yet, and that's why I'm a little bit suspicious, even at today's yield levels in the back end, and I think there is risk that they could still go higher.
Just to be clear here, though, Jim, at the front end, and I've heard this a few times over the last few months, and it's been the wrong call, but ultimately, your base case, do you believe that risks are skewed asymmetrically to the downside for lower yields at the front end?
At the front end, I do believe that's correct. I think that it is asymmetrically skewed towards lower front end yields.
Jim Karen, on the bond market, your 2-year right now, not doing much, up by a basis point. At the moment, the 10-year up by 8, the 30-year up by 10. Big moves at the long end again this morning and over the last week. Mirror Pandit, Jim Karen sticking with us. We're about 18 minutes away from the opening bell. Your equity market near session highs up 0.5%. Here's Simone with some movers going into the open. Hey, Simone.
Hey, John, that enthusiasm in the stock market's being reflected by many shares today. One of them is Lululemon. The athletic wear retailer extending gains from post-market Friday when the S&P Dow Jones indices said it would replace Activision Blizzard in the S&P 500. That change is going to be effective October 18th, but we're already seeing shares rally in anticipation of this flow story, up 6.5% in the pre-market. Not so hot, Charles Schwab. Reporting earnings this morning ahead of more bank results this week. Charles Schwab saying that net interest revenue sank 24% from the year prior. Clients were moving into higher yielding products. That helped lead to a big drop in third quarter revenues. This obviously important ahead of other major banks as well as regional lenders this week. Finally, Pfizer slashing its revenue and earnings forecasts for the year, but taking a particularly big hit on Moderna shares. Those down 3.8% in pre-market trading, leering there, lowering its price target to $64 per share. We're looking at shares higher, though, than 90 for the end of the week. So it's, that analyst seeing an extended period of unprofitability that they think is going to push the company towards restructuring here as that COVID demand really dries up.
Hey, Simone, thank you. More from Simone Foxman around the opening bell. Coming up, President Biden pledging support to both Israel and Ukraine.
We're the United States of America, for God's sake. The most powerful nation in the history, not in the world, in the history of the world. The history of the world. We can take care of both of these and still maintain our overall international defense.
Our reporting here at Bloomberg suggesting the president is considering a trip to Israel. Secretary Blinken returning to Tel Aviv. Your team coverage up next.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
The biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
We're the United States of America, for God's sake. The most powerful nation in the history, not in the world, in the history of the world. The history of the world. We can take care of both of these and still maintain our overall international defense. We're going to do everything in our power to find those who are still alive and set them free. Everything in our power. And I'm not going to go into the detail of that, but we're working like hell on it.
President Biden pledging assistance to Ukraine and Israel. Secretary Yellen telling Sky News the U.S. can support both wars, saying, quote, America can certainly afford to stand with Israel and support its military needs and also support Ukraine in its struggle against Russia. This coming as President Biden considers a trip to Israel in hopes of preventing the war between Israel and Hamas from engulfing the wider region. Your team coverage begins right now with Ollie Crook from Tel Aviv, AMH in Washington, D.C. Ollie, what's the latest on the ground?
Right, so as we know, Jonathan, what we heard from the Israeli defense units over the weekend is that the next stage of this war will include a ground component. The question is really not a question of if, but now when, and that is a question that we do not know the answer to yet at this stage. The main sort of focus for the military right now has been the aerial assault that has continued unrelentingly for the last week and that through the night and into today. And again, there's the question of aid, getting aid into there on the ground in Gaza, which is a very, very dire situation. But of course, there's also a tension that's splitting to the north, where there have been increased skirmishes with Lebanon. We understand that the Israeli government has now evacuated all of the civilians on the border with Lebanon 2 kilometers out. So this is the other question that we're watching. And of course, the U.S. response has been to send a second aircraft carrier unit into the region to, again, try to step up the deterrence a little bit more.
AMH, we've had a weekend of intense diplomacy and now reports here at Bloomberg that maybe even the president might be making a visit.
Absolutely, Jonathan. It's been frenetic diplomacy throughout the Gulf, and now the president himself is considering and weighing this trip to Israel. On one hand, this will show the U.S.'s forceful support for the Israeli people and their quest, what the Israeli military is talking about, really getting rid of and eradicating Hamas. At the same time, it would be a huge deterrence for the region overall, especially as Oliver is talking about Hezbollah in Lebanon or Iran writ large. This will be a huge deterrence for the region about the U.S.'s president. It also comes at a time that the U.S. is sending a second carrier strike group to the Eastern Mediterranean. We should not overlook the timing of all of this. So potentially the president could go as soon as this week, but Jonathan, we should note no decision has been made.
MH Jake Sullivan was talking about back channels between the United States and Iran. What came out of that?
Just that there are these back channels. I imagine it's the U.S. wanting to be very direct and frank with Tehran about not getting involved in this conflict. The U.S. really wants to make sure that they can isolate this just to what is going on between Israel and Hamas, not to have this really metastasize throughout the region. Really no surprise there, though, Jonathan, in the sense that the United States, of course, has back channels to Iran. They are just on the heels of doing a hostage swap deal that unfroze that $6 billion in aid that has become one of these touchstones for the Biden administration, that money that's sitting in the Qatari banks. They could do this through Qataris, they could do this through Omanis, they could do this through the Swiss. There's a number of ways they can have these back channels, and I imagine they are being very frank with Iran at this moment.
MH, our chief Washington correspondent down in D.C. Ollie on the ground in Israel. Ollie, stay safe. It's good to catch up, buddy, as always. Here's the latest right now. How do you process two opposing ideas? And Mira, I'll save you from this conversation for obvious reasons. When a bank CEO says this may be the most dangerous time the world has seen in decades, and then Jim Caron, the same bank CEO, reports a record quarter of net interest income, boosts the forecast for the year, and reserves for loan losses come in better than expected. Jim, how do I process two opposing ideas?
Well, look, I mean, it's very, very challenging right now. You know, in one sense, we have to look at economic valuations. We're coming off of a very, very strong third quarter. I think the economy is slowing. I don't think it's collapsing. So in many ways, when we look at the economic cycle, the economic cycle is marching to the beat of its own drum. Geopolitical events, you know, really create just a really large uncertainty factor. Until that really manifests itself, until we know what the conclusion of all of this is, or potentially what the fallout may be, it's not going to have an impact to earnings. So the earnings in many ways are backward looking, and they're looking at what had happened. On a go forward basis, you know, do we want to continue to hold risky assets? Do we want to continue to hold equity into this? I think unfortunately what happens is that markets get frozen. You know, we're already worried about a recession that potentially may happen next year. Now there are all these geopolitical events that are taking place, and we don't know what the fallout or how that's going to end up. So I think on a go-forward basis, what we can take away is that the run rate of the economy is okay. It's slowing, it's cooling, but it's not collapsing. It's okay. So I still want to own these cash flows. I still want to own these assets unless we learn something has fundamentally changed. So it's hard to square it and tie it up into a neat little bow. But that's the way that we're looking at it, is we want to really just create a durable portfolio where hopefully we have more upside capture the downside, but we do want to hedge the downside risk too, and high quality bonds can do that.
Chairman Powell talked about the struggle of navigating stars under cloudy skies. Mira, just how clouded is visibility going into 2024?
It's quite cloudy, and look, I think about it in this way. It's here today, gone tomorrow. When we think about economic growth, things can go from ripe to rotten pretty quickly, and there have been so many opposing views on the economy. Look, I travel quite a bit. I've never not landed when it comes to a plane, so I don't put a lot of credence behind a no landing scenario. I think we're probably circling the airport a little bit. It's a delayed landing, and while things look good today, none of the risks have been taken off the table. Many people are taking down their recession probabilities for next year, but we still have high rates. We still have a slowdown in lending that's going to take place over the next year. There are still headwinds to the consumer. So if you can't take those risks off the table, I don't think you can take recession off the table either. The good news is when you're talking about recession for 18 months, corporate America does have the opportunity to plan a little bit more robustly in terms of the resiliency of their revenues and making difficult decisions around expenses. So that has been an advantage. But corporate CEOs are also not sure whether we're going to have an ice storm, a sandstorm, a hurricane, or a heat wave. So that becomes hard to plan for, too.
British Airways into London Heathrow, round and round in circles. Anyone who's lived that nightmare every single morning trying to land there. Mira, thank you. Mira Pandit, Jim Carrington, to both of you. Thanks for the update. Equities right now, session highs up by 0.6% on the S&P. Coming up the morning calls and later. Big bank earnings giving way to big tech results later this week. That conversation still ahead with DWS Groups. David Bianco, Jason Goldberg at Barclays on the banks. All of that coming up soon.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
From New York
York City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Equities higher. Let's get you some morning calls. First up, Stifel upgrading Colgate to buy. 117 price target, pointing to improving margins and strengthening fundamentals. UBS upgrading United Health, expecting shares to rally after the company's impressive Q3 results. And finally, Goldman downgrading KB Home, seeing limited upside in the current operating environment. Coming up, earnings season ramping up with big tech results just a few days away. That conversation up next with David Bianco of DWS. Your opening bell just around the corner.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Names in global leadership are on Bloomberg.
Right from the start, I decided to open our border and to take in millions of refugees from Ukraine. We believed, and we still believe, that it is necessary, and we try to serve as neighbors should do.
If we want peace, if we want a negotiated outcome, strengthen Ukraine on the battlefield, because that's the only way to convince Putin that he will not win on the battlefield.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
Five seconds away from the opening bout this morning. Good morning to you. State of play looks like this. On the S&P, up by 0.6%. On the NASDAQ, up by 0.3%. 2 weeks of gains on the S&P 500. Helped out last week by the bond market. Yields lower following 5 weeks of yields moving in the other direction. There's your opening bell. Switch to the board and get to the bond market. Yields look like this now. They're moving higher again by 9 basis points. 470.60 on a 30-year, up by more than 10 through much of the last few hours. In the FX market, a euro clinging to some strength, Bit of dollar weakness, euro dollar 105.37. That currency pair positive by 0.25%, and crude lower by 0.6% to $87 and about 20 cents. About 20 seconds into this session, we look like this on the S&P. We're positive by 0.4%. We're up by a third on the NASDAQ. One stock to watch at the open, Pfizer, slashing its revenue forecast after agreeing to take Paxlovid doses back from the government following weakening demand. Jefferies upgrading shares to buy, writing this: Paxlovid cuts largely drove the downward revision. We see an attractive catalyst path ahead. Simone Foxman has more. Hey, Simone.
Hey, John. Yeah, shares here up more than 1.5% despite this dramatic cut to its guidance for the full year. Earnings per share had been something like $3.25 to $3.45. The company now seeing $1.45 to $1.65 a share for the full year. Revenue expectations had been 67 to 70 billion, now just 58 to 61 billion. Wall Street estimates had been on the low end of guidance, but not quite this low. And we did see losses in the pre-market, but clearly we have gone back to some gains here in the early market trading. CEO on a call this morning talking about how just 17% of Americans will get a COVID booster, and a lot of this weighing on demand for Paxlovid. But there were some positives here. The company agreeing to take back 7.9 million courses of Paxlovid from the government. This clears out some of the inventory that's been in the market. So it'll allow Pfizer to sell these doses at likely about $150 more than they were selling them to the government. Pfizer also announcing a cost-cutting plan. Wells Fargo joining in with Jefferies there, saying that this is a reset. This is a good first step towards the recovery. The magnitude of weaker demand is likely surprising for investors, but clearly they're not daunted this morning. Shares up 2.4% after declines of some 36% this year, John.
32.93. Simone, thank you. Simone Foxman on top of the Pfizer story. Let's turn to sports. Manchester United falling after news of the Qatari group was stepping back from a potential takeover. Guy Johnson has this one. Morning, Guy.
Morning. So it looks like Jim Ratcliffe's Ineos's Jim Ratcliffe is going to buy a 25% stake, John. But what's interesting, he's going to pay around 1.3 billion for that, which means effectively he is paying a greater premium. 25%, does that remove some of the challenges that Manchester United face right now? 10th in the league, bottom in the Champions League. Is this going to be the big step change for this club? It's interesting, at the moment, we're all watching what is happening or happened with David Beckham, and it kind of just reminds us of the glory days of Manchester United. Is Jim Ratcliffe and that 1.3 billion going to be enough to end the Glazer era? Probably not. Is it going to be enough to compete against some of the super rich clubs we now have in the Premiership? Probably not. Does this take this club forward significantly? Well, I guess you can probably suspect the answer to that question as well, John.
I've enjoyed that Netflix series, Guy. I enjoyed that a lot. Guy Johnson, thank you. Out of London. Look out for Guy's coverage there with Alex Steele on that name. Manchester United now down by about 8.8% in early trading, 18.24. Let's turn to chips. Semiconductor stocks underperforming after Bloomberg reported the US plans to tighten China's access to advanced chip technology. Ed Ludlow on top of this. Morning, Ed.
Yeah, good morning, Jonathan. According to Bloomberg sources, the intention here is to reverse the loopholes and deficiencies that were in place, frankly, when these curbs were first enacted a year ago in October of 2022. In terms of what the specific actions are, Bloomberg sources tell us that we are looking at graphics cards or GPUs in AI, but also the chip-making equipment at an advanced level that goes into that. What the US is going to do is, A, impose additional checks on Chinese companies which are basically routing shipments through other nations in order to circumvent or evade export restrictions. They're also going to relook at the restriction list and go for some of the Chinese chip design firms. In other words, if you want to do business with one of the Chinese chip design firms and they are on that list, you're going to need a US license or waiver in order to fulfill orders with that company. Sources saying that these updated restrictions could be published as early as this week. It's interesting to note the response to this Bloomberg reporting. Spokespeople for the National Security Council declined to comment. A spokesperson for the Commerce Department's Bureau of Industry and Security declined to comment, but a Chinese Foreign Ministry spokeswoman, Mao Ning, said, quote, that the US is politicizing, instrumentalizing, and weaponizing trade and tech issues, and for that reason, they'll continue to monitor it. This is the equity reaction. It was more pronounced in the pre-market. You actually see a number of those names now higher. The expectation that tighter curbs would come. But note that overnight in both the Asian and European session, both chip equipment makers and other names that hope to do business with China or have exposures to China on the top line did see downward movements, John.
Ed, thank you, mate. Appreciate it. Ed Ludlow, Caroline Hyde, noon Eastern on Bloomberg Technology. I have no doubt they'll be talking about this next story. I want to stick with China. Sales of Apple's new iPhone 15 worse in China than its predecessor over their first 17 days after release, according to a study. Mandeep Singh on top of this one. Mandeep, what's happening?
Well, so clearly, expectation was that there will be pent-up demand in China for the new iPhones, and it looks like from the data that we have seen so far, that doesn't seem to be the case. And look, with Apple, they've been taking share in smartphones over the years, albeit, it was 1 to 2%. In this case, it doesn't feel like a pretty big upgrade, and that could be part of the reason why this is the case, but it's too early to say that, they've got issues where people will just not upgrade their iPhones at all. It's not as if they're losing market share here.
Mandeep, for China specifically, do you get the feeling this is just weak consumer spending trends, or is this competition?
Well, I think it's too early to say it's competition, simply because with Apple, it's about the ecosystem. And, I think what they're missing here is a new device category. People are just keeping their iPhones a lot longer. And they didn't provide enough features, barring, a new camera for people to go out, the existing iPhone users to go out and upgrade their phones.
Mandeep, thank you, sir, for the latest on this. That stock is down by about 0.5%. Two reports here. One from Counterpoint Research, who said sales of Apple's flagship device are down about 4.5% compared with the iPhone 14 over the first 17 days following release. Another report from Jefferies, the analyst there led by Edison Lee, reckons sales of the iPhone 15 were down by an even sharper double-digit percentage from its predecessor after Huawei outsold Apple overall. Again, need to work out one, to Mandeep's point, if it's too early, but ultimately if this is the story. Two, is it consumer trends? Or three, is it competition? We'll get to that, no doubt, through the next couple of months. That stock just a little bit lower, softer, lighter, negative by a third of 1%. Earnings season starting to pick up momentum. Big tech stocks like Netflix and Tesla joining the banks in reporting results this week. Citigroup's index of earnings revisions revealing downgrades have outpaced upgrades for 4 consecutive weeks. Morgan Stanley's Mike Wilson weighing in right in this. We should see an upward inflection in earnings revisions breadth into year-end from here. If revisions underperform over the coming weeks, it would be a sign that other risks, including macro headwinds, are driving the earnings revisions backdrop. I want to continue this conversation now with David Bianco of DWS. David, to you, sir, on the earnings, what are you looking for from big tech later this week?
Good morning, Jonathan. Well, we're going to be looking for big tech to produce good results, probably not great. And we're going to be counting on big cap tech and communications to do the heavy lifting for earnings next year. But my expectation, as we're in this first proper week of earnings season, we'll keep an eye on more of the companies to report while keeping another eye on the bond market. But I do think that even though earnings are going to be decent this year, and there'll be a little bit, maybe 1% growth versus this time last year and also this time 2 years ago, I don't expect there to be strong earnings results that boost this market to higher levels, particularly not with the geopolitical backdrop and the climb in long-term yields. By the way, I do think as earnings season goes on and the year goes on, the estimates for next year will be cut significantly.
David, that's the earnings. You mentioned the bond market. Is the bond market still in the driving seat for equities from your perspective? And should this equity market take comfort from last week's drop in yields?
Yeah, the bond market's still in the driver's seat because the PE multiple is where there's a lot of uncertainty and volatility. We're all keeping an eye on not just the pace of the climb in the 10-year yield, but does it flirt with 5%? Does it go over 5%? If the 10-year yield goes over 5%, I think it's going to spoil any kind of year-end rally for the equity market, probably compress the PE on forward earnings by closer to 18. So to me, the Fed needs to say the job's not done. they might need to put a hike through November 1st, or at least continue to threaten to do so, because the bond market's concerned about the deficit, and if the Fed doesn't stay hawkish, I think the long-term bond market could continue to flirt with 5% on the 10-year yield.
Interesting. David, I think this is really important. We always start with this question: is the bond market in the driving seat for equities? Then we get to the next piece of it: should we take comfort in the drop in yields? David, what's often lost, and I think is equally as important, if not more important, it's what's driving bonds. What is behind the point that we saw last week, yields aggressively lower, then before that, over the previous 5 weeks, yields aggressively higher? What do you think is the dominant driver of things? And does that matter to whether you should take comfort from it or not for equities?
There's multiple drivers, but probably the newest and most significant driver of late is the deficit and the dysfunction in Washington, D.C. And then there's the still ongoing battle with inflation. While it's coming down a bit too slowly, particularly from the perspective of a long-term bond investor. The inflation break-even is about 2.3, around there. So the long-term bond market still believes the Fed's going to get the job done and get inflation back to 2%, 2.0 eventually. But the question is, how high do they need to hike rates in order to get inflation down and prevent any risk of a reacceleration of inflation? If inflation reaccelerates while this deficit continues to be a major problem, yeah, that's how you can end up getting an over 5% 10-year yield real quickly. So the Fed, I think, needs to go into the next meeting thinking what action of theirs, what language of theirs most prevents or mitigates the risk of a 10-year yield jumping over 5%. While long-term yields are doing some of the work for the Fed right now, I think if 10-year yields go over 5%, it'll do too much work and raise the risk of a hard landing. The Fed certainly doesn't want that either.
David, with that in mind, you're underweight tech, you're underweight autos. Is that a bond market call?
No, it's actually more of the valuations are just a little too demanding. There are parts of tech that are still cyclical. There are particularly tech hardware, even semiconductors. They're not all artificial intelligence plays right now. So we do think the valuations are demanding with or without the risk of higher interest rates. And while we do expect strong earnings growth out of tech next year, it's going to need to be well into the upper teens, and that will need to be the outlook for the next few years to justify these valuations. That's a demanding outlook given the world economy, currency, the dollar's strong. We do think that tech software and some other companies can do it, but it's a lot of growth to ask for this sector, albeit it is the biggest sector of the S&P.
David, just finally, what are you advocating for in the financial sector?
Well, in the financial sector, we like the biggest of banks. We already heard from that one. But that's not an indication of what's going on at all of the banks. We're still cautious on small banks, capital markets. But the big money center banks, we find those valuations attractive enough. And we like insurance companies, given this new yield to be found in longer-term fixed income. That benefits the insurance business model.
David, good to catch up, buddy. As always, David Bianco there of DWS. Coming up, more big bank earnings on tap.
For all of the fears out there, John, around this bank so-called crisis, the earnings so far that we've seen have been quite good. So we feel pretty good so far to start these earnings season.
With equities up by 0.6% on the S&P, about 13 minutes into the session. That conversation on the financials with Jason Goldberg of Barclays up next.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of ON's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined ON as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but ON's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
The fears out there, John, around this bank so-called crisis, the earnings so far that we've seen have been quite good. What it shows, John, more than anything, is just the resiliency of these business models. And despite all the machinations of rates and credit and capital, the earnings stream and the revenue streams of these banks is actually quite annuity-like or utility-like in nature. So we feel pretty good so far to start these earnings season.
Big bank earnings resuming this week. Bank of America, Goldman reporting Tuesday, followed by Morgan Stanley on Wednesday. Today, investors digesting numbers from Charles Schwab, reporting a 24% decline in net interest revenue as clients move cash into high-yielding products. Bloomberg's Sri Natarajan joins us now for more. Sri, what's the latest?
Well, you're right about Schwab, John. Everyone's focused on their results. They've, of course, been a big problem child this year, with the stock down about 40% coming into earnings today, which would make it their worst year in more than 20 years. There has been a bit of a bounce in the results. Deposits are down, but not as bad as investors expected, and that is perhaps leading to some more hope, especially in September. The trend has been decelerating, and investors will hope that stands true. But really, we're heading into tomorrow and Wednesday when the remaining three big banks will report. That's Bank of America, Morgan Stanley, and Goldman Sachs. Those three also happen to be the three worst performing big bank stocks. Slightly different dynamics. With Bank of America, you'd be looking at what are they saying about the economy? What are they saying about loan losses? Because that's what we heard from JP Morgan and Wells Fargo. Despite improving their NII outlook, JP, Wells, and even Citigroup talked about loan losses increasing on the forward. With Goldman Sachs and Morgan Stanley, however, all the commentary and all the focus will be where are they seeing the rebound in investment banking activity? Will 2024 look way better than where it is right now? Because when they report their third quarter results, investment banking results will still be depressed, and perhaps that's a reason for why the stocks, both at Goldman Sachs and Morgan Stanley, are down about 9 and 10% this year.
Things a little quieter for Mr. Solomon over at Goldman as well. Sri, great reporting as always. Sri Natarajan there of Bloomberg on the latest. Barclays weighing in on the challenging environment facing the banks, writing this. The Fed has signalled interest rates next year could be even higher. The UAW went on strike, the government shutdown was delayed, and oil prices have increased. While we don't expect these factors to impact near-term results, they could weigh looking out. Jason Goldberg at Barclays, I'm pleased to say, joins us right now. Jason, overweight B of A, overweight Goldman, overweight Morgan Stanley. What's the read across from the numbers, Jason, that we got on Friday for the names that fall under your coverage over the next 48 hours?
Yeah, no, I think we did learn a lot on Friday. I mean, what you saw from, JP Morgan and Wells Fargo was both net interest income and loan loss provisions were actually better than expected, allowing both companies to exceed consensus forecasts. And then if you look at the capital markets related revenues, both Citigroup and JP Morgan posted higher FICC revenues from a year ago. And while equities was down, it was down relative for tough comps. And both Citi and JP Morgan actually posted increases in investment banking fees from the prior quarter, although that was fairly a subdued quarter. But you did see a bounce back in advisory revenues, kind of overshadowing continued weakness in equity underwriting. Although both kind of indicated September was an approved month, which could bode well, for the back half of this, the latter part of this year into next.
Jason, just to build on what we could see in the next few months and maybe even into next year, you said it coming into the release for these earnings from these big banks on Wall Street. Loan growth was subdued. Deposit costs have been increasing. Jason, any reason to believe that those issues ease in the coming quarters?
Probably not, but keep in mind, the pace of deposit cost increases, at least from the 4 banks we saw report last week, was, smaller than the increase we saw in a prior quarter. And typically deposit costs tend to peak, a quarter or two after the Fed stops hiking. And so we'll feel like we're, I'm not sure if we're at the end of this Fed tightening cycle, but we're certainly kind of near the tail end of it. So we would look for deposit costs, to peak next year. And listen, loan growth is going to be somewhat reflective of the economy. It was certainly subdued, so far this quarter, outside of credit card, and likely to remain a little bit pressured, until we get kind of further clarity if the Fed can actually engineer a soft landing.
Bank of America year to date, these numbers already, down almost 20%. JP Morgan year to date, up 10%. That is massive relative outperformance for JP Morgan. Jason, what explains that?
Yeah, I think for JP Morgan, a lot of the upside, I think they're a big beneficiary of the acquisition of First Republic, which is certainly additive, to earnings this year. So I think that helped them. With Bank of America, there has been some concerns around unrealized losses related to their securities portfolio. And while we certainly don't think that's going to actually, weigh looking out, it is something that has bothered investors, particularly, given issues some smaller banks ran into earlier this year.
Jason, what gets them out of the penalty box? Is it just the bond market rally? I asked this question last week. What else can they do?
Yeah, I think time. I mean, listen, to date, every single security in their portfolio essentially has matured at par, and those, unrealized losses go away. And looking out, we expect that trend to continue. It may take some time. But whether it's a function of securities pulling to par or, ultimately rates going lower, those unrealized losses, will go away. And mind you, right, each quarter they generate cash flow off their securities portfolio that they get to reinvest at much higher rates, which should help benefit net interest income. And in fact, despite, some headwinds, we still expect net interest income to grow in the high single-digit area this year.
Jason, good to catch up with you. As always, busy week ahead, I know, for you and the team. Jason Goldberg there on the latest in the financials over at Barclays. The broader market at the moment up by 0.6 on the S&P, up by 0.5 on the NASDAQ. Let's get you some sector price action. Here's Simone.
Hey, John. Yeah, every sector higher so far in early trading, led by the consumer's discretionary, real estate and utilities, the end negative here or actually positive here for the day, but lagging behind so far. I'm particularly focused on the communication services sector. Bank of America talking about how we've seen a larger share beat on earnings. We'll start to hear some of these consumers communication services names coming in with Netflix, AT&T. These are the laggards so far this month, but we don't expect to get Electronic Arts, Alphabet, Meta, some of the bigger names until later this month, early next month. Year to date, though, we're on pace for the biggest surge since 1998. This index up 44%.
Simone, thank you. If you don't like Fed speak, here's the bad news. Pretty much every single Fed speaker is speaking this week. Here's the good news. The quiet period is just around the corner. Your trading diary is up next.
I was putting so much pressure on myself. And when I changed my mindset midway through the tournament and just approached it one game at a time.
Lloyd with Morgan streaking. She's chipping the goalkeeper! Off the post and in! Hat-trick for Lloyd!
I went from really just being under the radar to suddenly being in the spotlight.
You know who I'm talking about, Carly Lloyd! Carly Lloyd! Ladies and gentlemen, we have an American hero!
We had speaking engagements, sponsors that wanted to sign me, appearances, you name it, I had it. It became very mentally draining for the next easily couple years because I was extremely busy. But I knew that if I'm going to have any type of retirement, any type of financial stability when I'm done playing, I had to take every advantage of my opportunity.
Equities up. Here's your trading diary. Secretary Blinken meeting with Israeli officials Tuesday. B of A, Goldman earnings. Wednesday, Morgan Stanley, Netflix and Tesla. Thursday, another round of claims plus. Fed Chair Jay Powell headlining a week full of Fed officials ahead of the quiet period. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Mick Mulroy. He's a former CIA paramilitary officer and co-founder of the Lobo Institute to get his thoughts on the latest from Israel. Then we're going to check in with Alex Mars, CIO at FM Investments, to get outlook for markets going forward. Then Ed Ludlow, host of Bloomberg Technology, he's going to talk to us about Apple iPhone 15 sales coming in a little lighter than expected. We're going to get the lowdown on there. But we're going to kick this whole thing off like we like to do with Mr. John Tucker of Bloomberg Business Flash.
All right, green on the screen this Monday morning. S&P 500 halting the two-day slide. Traders also gearing up for a raft of earnings reports, of course, over the next few days. Treasury 10-year yields advancing 10 basis points. 471 on the benchmark Treasury. And Bitcoin, right now it's pairing some of the earlier gains. It surged as much as 10%. We'll call that a risk-on move. Lori Calvasina at RBC Capital Markets says, stocks may get a lift as earnings season gains momentum.
So earnings have started, and the numbers have actually been pretty good so far. When we look at the companies that have beat consensus expectations, they're actually performing a little bit better than the broader market by a bigger clip than what we've really seen over the past year and a half. So people like the results.
And right now, shares of Apple among the most actively traded, as they usually are. They are down about 0.7%. Ed Ludlow's going to have more on this, but the iPhone's off to a sluggish start in China. Lockheed Martin continues to produce F-35 jets with flaws discovered even after the jets are delivered to the U.S. military. That's not helping Lockheed Martin's shares today. Overall, the S&P 500, 28 points higher. That's up 0.7% at 43.56. The Dow Jones Industrial Average up 245 points. That is up 0.75% at 33,914. And the Nasdaq 100 right now, 110 points higher. That is up 0.75%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
John, I don't think I want to be flying at like Mach 2 and
but
have
also
a plane
it's just
that
like
has
one of the
flaws.
most expensive
Exactly.
expenditures by the
Guys.
Defense Department, and you, the taxpayer, in history, you would think they'd be like ready to go.
I'm sure they're still pretty good.
Yeah.
I wouldn't want to go up in a fight against an F-35.
Now, I should point out none
they're
of
okay.
these flaws is considered to be life-threatening
or mission critical. Okay,
mission critical.
Let's not let good be the enemy of perfect, gentlemen.
There you go. All right, John Tucker, thank you so much. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so you can head over to youtube.com and search Global Bloomberg Radio, and that'll get you right where you need to go. Bailey Lipschultz is right where he needs to be, right here in our Bloomberg Interactive Broker Studio. Got some green on the screen here, Bailey. What are you looking at under the hood?
Yeah, kind of an interesting divide among COVID shot makers. Pfizer right now up 4%, Moderna down 6.9%. This coming after Pfizer cutting its expectations for its COVID vaccine and Paxlovid, that oral medication. Interesting thing was that Pfizer was down nearly 10% in late trading on Friday evening when the news was announced, now up 4%. So quite the reversal. Looking at some of the analysts and strategists' reaction, a lot of this discrepancy is driven by the fact that Pfizer is one of the largest U.S.
Well, here's my
companies.
security and former security analysis take on this. The reason the stock's up because it removes the hangover or the overhang. The overhang of you just didn't know what the risk was to declining COVID products sales. Now I can put a number on it. Now it's in the rearview mirror. Now I can look forward.
Still pretty brutal though when you come in that far below. I guess, Paul, I'm more interested, just given your experience, then why does it drop 10% almost in post-market?
Initially, you're like,
trading?
Initially, it's the headline. Oh my God, they're taking guidance down, sell stocks. Now you're like, once you think about it, you're like, okay, wait a minute. Again, this was an overhang, I think, for the stock.
Yeah.
You just didn't know. Was it $1 billion? Was it $10 billion? Was it $100 billion? You didn't know what the number is. Now I know what the number is. Now that uncertainty's out of the stock, And so now I can come in and start buying some stock. That's just my take, but we can talk to somebody.
Also, the stock is down 35% this year to date, right? So it's done pretty poorly. That's the overhang there.
It's good for society, right?
They're all bad.
We're not going to need it. We're not going to. I haven't gotten my booster yet.
I'm getting it. My wife forced me to get an appointment this week because we're going to have a baby next month. So she was like, "You got to get."
Otherwise, you would not have gotten it.
Either
This is
the
the
shot,
flu shot?
No,
Or
I got
the
the
flu?
COVID. She said you have to either get COVID or the shot now. And I have been trying over the past few weeks to get COVID, and it hasn't worked.
Just get the booster. I'm going to go get the booster. I don't know. I guess I got to go out on my own and do it. Usually Bloomberg did it for me.
Get the shot? Yeah, it used to be downstairs, but I had to make an appointment at CVS, which will be an S show. Obviously, it's going to be like 50 people lined up. Everyone waiting to get prescriptions. They got like one pharmacist behind the counter. All the toothbrushes are locked, so people are ringing bells to get toothbrushes out. Like, I don't know how that business got so bad.
Yeah.
Let's talk about Bitcoin for a second.
I was going to say that.
Thank you, because
talking S shows.
Tucker said it's a risk on, and to some extent it is with the rest of the market. But the idea is there were reports this morning that the SEC wasn't going to appeal a court ruling against, wasn't going to appeal the court ruling that said, it's been too harsh on ETF decisions, especially grayscale, right? And now there was a story out from Benzinga that said, SEC has approved BlackRock ETF, which according to BlackRock, actually isn't the case. And we don't know from Grayscale yet what the story is with their conversion into an ETF. But there's a lot of ETF action in the headlines, and that's, I think, what's driving Bitcoin higher.
No, exactly, and that's why it's reversed those gains. Again, up as much as 10%, now back down to 2.7%, trading right around $28,000 a token, because Bloomberg confirming that the iShares Spot Bitcoin ETF application is still under review. So as you mentioned, Matt, a lot of mixed signals, a lot of uncertainty, and it really does go to show continuously how one headline, whether it's spread on
BlackRock says it's still under review, right?
Exactly. Yeah, that's
they
what
don't
they
know.
said.
Maybe the SEC is done with the review. They just haven't told anybody yet. And the story
is the expectation that it will happen. There will be a spot.
Of course.
So
because
why am I not buying Bitcoin?
There's another story from Bloomberg, according to a person familiar, that the SEC is not going to ask a federal appeals court to reconsider a ruling that paves the way for Grayscale to launch a spot Bitcoin ETF. So that was on, I think, Friday night. And because of that story, now there's been a ton more speculation about BlackRock's ETF, about maybe Cathie Wood's ETF, and so the market is going a little bit nuts. That's why everyone's buying Bitcoin today. Yep. And when the ETF is actually approved, they will sell it.
Ah, there you go. Yeah. Okay. Anything else for us, Bailey?
Henry Schein down 2.9%, ticker HSIC, healthcare supply chain. Stock underperforming, one of the worst performers in the S&P 500 after a cyber attack hitting parts of its operations that happened on Saturday. Also looking at weakness within kind of the similar space. Walgreens Boots down 2.7%, just selling pressure.
Rite Aid's bankrupt.
Rite Aid went bankrupt. A lot of issues across the places that I buy cold medicine and sometimes alcohol.
The places where you ring a bell to have someone come unlock the cold medicine for you while you're waiting in line behind 40 people waiting.
Now, is that up in Westchester?
Dude, that's everywhere. At Rite Aid, CVS. I mean,
Okay,
none
so
of
like
them are
that in
good.
Jersey.
Walgreens,
Yeah.
they're all like that.
No,
Around
not in
here, at
Jersey.
least.
Okay. I know it's Manhattan, but I didn't know if it was outside.
No, I will say I went to CVS. I have a cut on my hand. I had to buy some saline spray. $13 at CVS, $4 at ShopRite.
Was it locked, or were you able?
No,
to
thankfully it was unlocked. So it took me about 3 minutes to grab.
He bled all over the cabinet.
What did you do? You took a spill off your bicycle?
Dude, I was running downhill in the dark before work on Wednesday morning and thought I broke my toe. My hands and everything's cut up. I'm a mess.
Okay, say A, no running. That's what we learned there. B, certainly not in the dark.
No. I mean, that's a New York Stock Exchange rule from way back. No running.
No running on the floor.
No.
All right, Bailey, heel up there, my friend. Bailey Lipschultz, he covers the equities when he's not falling down running. He covers all that stuff for Bloomberg News. All right, let's get to the latest on Israel, because it just, once again, we're just waiting, it seems like, for Israel to make the next move here and how decisive it will be. Mick Mulroy joins us. He's a former CIA paramilitary officer, and he's a co-founder of the Lobo Institute. Mick, thanks so much for joining us here. It seems like everything we see and read from all the reporting that Israel is going to go big into Gaza. I guess the question is when, and then what do you think, I guess more importantly, what do you think a realistic objective for them is?
Well, it's good to be with you guys. I do believe it's coming up. So I think we're in the last stages of preparations. We've seen the preparatory fires to soften up the targets, take out some leadership. We've seen some small incursions probably by special operations forces to try to find the best route for the main body to get in and potentially to try to get information on where the hostages could be. And now we're going to see a giant movement of all these tanks and armored personnel carriers and, combat engineer vehicles. They're going to leave the assembly area. They're going to get in their attack formations and then likely enter from Erez up at the top, because that's the best when it comes to terrain for all these formations to get into, and then funnel in to the top, going straight toward Gaza City. And to your point, they're going big, and it's going to be violent. They'll probably have some come in from the sea to create a dilemma from Hamas, maybe some coming from the air to try to drop behind them in central Gaza, to also to try to create a dilemma and envelop them. But once they get into the actual fighting, it's going to be block by block. I'm hearing the Israeli planners that talk to me talk about upper and lower Gaza. Upper being buildings and everything that you see normally in a city. Lower is all these tunnels. There's around 300 miles of tunnels down there. And that's going to be bare militarily to try to conquer.
How deep are the tunnels? Why can't... A couple of questions I've had, and maybe you can help, Mick. How do they block the sea border? I mean, why wouldn't people in Gaza be able to get out on boats or, even swimming, as rudimentary as it sounds, right? They're on the sea. How do they block that?
So there's been a naval blockade in place by the Israelis for some time, because that was one of the means of which Iran, quite frankly, smuggled weapons into Gaza. The other was through the tunnels leading into Egypt. So that's been blocked. If boats were allowed in, there could be some exfils, civilians leaving that way. But I don't think the Israelis are letting any vessels in any of the sea space right off the coast of Gaza. I do think they'll try some kind of amphibious landing, maybe just a small special operations type force, or more like a giant or a large marine formation, like the Marine Corps type formation hitting the beach. Most everybody is going south via vehicle or foot.
I also wonder, we talk about the objective for Israel, but going back to the terrorist attacks that we saw last week, why did Hamas do that, other than, spreading terror and, I guess, retaliation against what they feel has been done to them? Do you think they're trying to bait the Israelis into Gaza?
Yes, and that's a good point of your question. So when they attacked Israel like this, they had to know that this was going to happen, and I think they did. Why did they do it? Obviously, to your point, terror. They're a terrorist organization, been designated as such since 1997. But also, they want to disrupt all of the diplomatic efforts in the region. We've already had the Abraham Accords. Saudi Arabia and Israel were getting close to normalizing relations. This is not good for Hamas. It's not good for Iran. And if it's not good for Iran, it's not good for Hamas or Hezbollah. And that's potentially part of what you're trying to do. And then the last part militarily is to get them into a fight like this, because the IDF is one of the most advanced militaries in the world. But urban fighting, tunneled fighting, subterranean fighting, it takes away a lot of those advantages. And they have this place wired literally to fight the benefit on their side. So that is why they want the IDF to get into this battle inside Gaza City, for example.
Hey, Mick, I mean, do you think the IDF has been able to identify over the years who actually is in Hamas? I mean, the leadership is one thing, but of the 1,500 or so Hamas terrorists that came across the border, does Israel know who they are? Did they know really? Can they really neutralize Hamas as a terrorist organization?
So there's going to be a lot of the Hamas fighters are going to fight, so they're going to die, and that's going to be. Then they're going to gather all those, and then the ones that they capture, they're going to go through every camera, And of course, Israel, like most modern countries, has cameras everywhere, and try to make sure that they've identified everybody, either dead or alive, that took part of that operation. And they also keep detailed records on who they believe is in Hamas and their leader. Sinwar is in Gaza City. He is one of the most significant leaders in Hamas. He's going to be target number one. And they've already taken about 12 of the senior leaders around him out so far, just since the preparatory fires started.
And Mick, one question I ask kind of consistently to guests on this topic is, how much collateral damage do you think Israel is willing to inflict in order to achieve their military objectives?
Well, I would hope, and I do believe they will, adhere to the law of armed conflict, which is to do everything you can to limit civilian casualties. And the first step is getting this humanitarian corridor that allows civilians to leave northern Gaza and move to southern Gaza, hopefully in a UN-sponsored safe haven that's monitored. There's plenty of effort underway to set that up. But I do think Israel, the IDF, will do everything they can to limit civilian casualty. That said, this is urban fighting with armored personnel carrier, multi-dimension. There's no doubt that Hamas is going to hide behind civilians. There's no doubt they have buildings wired and tunnels wired. So there's going to be a lot of civilian casualties, which is why I think there's been so much effort recently to get as many civilians as possible. And I think last I heard was 500,000 have left northern Gaza. Everybody that can leave should leave.
Last week was much harder for me than I expected mentally. And I don't even have a dog in this fight. It just hurt to see all of the damage inflicted by the terrorist attack first, and then looking at the pictures of women and children in Gaza in the hospitals was also, the little girls look like my little girl. How do you deal with this as a soldier, as a leader? How do you deal with that part of it?
So that's the part I think that's the most lingering and the stuff that causes, quite frankly, veterans the most grief, along with losing their friends for the longest period of time. You'd hope that if, quite frankly, if adult men would start wars, they should be the ones fighting it, right? Not little kids as we see around the world in so many places, and certainly not all these innocent civilians who just happen to be caught in the crossfire. As you said, whether it's in Israel, whether it's in Gaza, or whether it's in Ukraine. It's just unacceptable. It's why most of the UN protocols came after World War II, is to try to prevent civilian casualties like this. They just should not be part of anybody's combat operations and their plans. They should be completely excluded. Unfortunately, it looked like Hamas's sole purpose, quite frankly, was to kill civilians when they went into Israel. They actually bypassed many of the IDF's areas.
All right,
now
Mick,
we need to try to do everything we can to save civilians in Gaza.
All right, Mick, thanks so much for joining us. As always, Mick Mulroy of the Lobo Institute. All right, let's go to Lisa Mateo right now and get some company news.
Thanks, Paul. Apple's new iPhone 15 is selling far worse in China than its predecessor. That's according to separate studies, which cite a rise from rivals like Huawei Technologies. More from Bloomberg's Kriti Gupta.
Even though we, back in the States, know that Apple is kind of the #1 iPhone smartphone maker in the West, that is not the case in a lot of these emerging markets, especially in China as well. China, however, is Apple's big growth market, and that's really where you're starting to see the pain point here.
According to Counterpoint Research, sales of Apple's flagship device are down 4.5% compared with the iPhone 14 over their first 17 days after release. Meanwhile, Apple is making it easier to get the latest updates on your iPhone. Bloomberg's Gina Cervetti has that story.
Oftentimes, when someone gets a new iPhone from an Apple store, it does not come with the latest updated software. But now Apple is planning a new system that will update iPhones while they're still in their box prior to sale. Bloomberg tech writer Mark Gurman reports the company has developed a pad-like device that wirelessly turns on the phone, updates its software, and then powers it back down while the iPhones are still in their boxes.
Apple right now down about 0.3%. And Netflix is deepening its push into the video game industry, creating more titles based on its popular movies and TV shows. The Wall Street Journal says over the next several months, subscribers will be able to play games with their mobile devices based on hits like Squid Game and Wednesday. Games based on the series Extraction and Black Mirror could also be in the works as well. Netflix right now, they're up about 0.6%. Those are the company stories we're following this hour. We'll have more Bloomberg Markets in just a bit. I'm Lisa Mateo, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash being brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit Commonwealth.com to learn more. While stocks are rising, the traditional havens, including gold, the U.S. dollar, and treasuries are losing ground right now. You have oil prices. They are lower after jumping Friday to the highest since the Hamas attack on Israel. And some data today, New York Fed reporting factory activity across the Empire State contracting this month. That reflects a pullback in orders. Then you have BlackRock saying its iShares Spot Bitcoin ETF application is still under review by the SEC. Hasn't been approved yet. Bitcoin up, but pairing an earlier surge that we saw. S&P 500, 37 points higher. That's up 0.9%. 43.65 of the index. The Dow Jones Industrial Average, 262 points higher. The NASDAQ 100 up 161 points. That is an over 1% rise right now. The benchmark 10-year, 9 basis points higher, 470 right now. The 2-year, 2 basis points higher, 5.08%. And let's finish with the biotech Prothena. It is up about 17%. They're developing a treatment for Alzheimer's disease, preparing for a potential sale ahead of some key data. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
All right, JT, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live as well on YouTube. Looking at INGO, the Bloomberg Index browser, looking at fixed income, man, it is ugly. If you aren't in high yield, you're losing money again this year in fixed income after double-digit declines last year, which were historic declines last year. Not much better this year, again, with that exception. The U.S. Corporate High Yield Index up about 5.1%. What's a fixed income person to do these days? Let's check in with Alex Marr, CIO at FM Investments. Alex joins us live here in our Bloomberg Interactive Broker Studio, so he gets extra points there. Alex, where do we go here? I mean, do we just sit? I mean, with all the geopolitical angst in the marketplace, I might just go crawl into a corner, into a little ball, and just buy my 2-year treasury at 5%, and that's it.
Well, and that's what a lot of folks are doing, 2 years or shorter in on the curve. I mean, why would you not clip a 5% coupon? It's a pretty material yield, certainly versus what we were talking about 2 years ago. It was choose your flavor of zero. I think, though, the key for folks is if you've been in that trade, it's a good trade to be in. We run the on-the-run ETFs, so something like T-bill or U2, where you can do that, and we'll keep the roll for you, which is really important now as we look towards the end.
What's the ETF? Sorry.
T-bill.
What's the ETF ticker?
TBIL, and the U2, UTWO. So the T-bill is the on-the-run 90-day. XBIL, XBIL is the 6-month, and UTWO is the 2-year. And
Are you seeing flows coming in there?
We started with a zero 14 months ago, and we're about $3.3 billion today.
No kidding.
And so folks are coming in. A lot of it's yield, and it's great, but now increasingly.
Why don't we start ETF, man? You do a TV show.
I mean,
and stuff.
You mean what? Why don't we buy an ETF or start an ETF?
Start an
Our
ETF.
own ETF.
Yes, look, this guy went from 0 to 3 point.
Well, he had incredibly good timing. Okay,
and he's a professional.
Yes.
Okay.
I'll take the timing over anything else, though. But we increasingly see people coming into the belly and the long end of the curve. We have all the yield curve now put into a simple on-the-run ETF, and folks are starting to buy the 10s, the 7s, the 5s, which is great because you're not penalized for being a few months early on that trade. Actually, being a couple months early is the best place to be. But once the trade starts to happen, then it really hits hard. And if you look at the yield curve, there's a wrinkle in how this de-inversion is starting to happen. Normally, the front end of the curve just falls off a cliff pretty quickly, right? We say rates go up the escalator and down the elevator. But this time...
I heard that one. That's a good one.
Yeah, I wish I could
take
take credit for it.
Because I'm an equity guy, I try not to stay... I stay away from you guys. But
it's the problem, though, is now as we look at how we're going to de-invert, the back end of the curve is coming up, which is really what the Fed wanted to do. Wanted to put long-term expectations where they really needed to be, which wasn't 1%, quite frankly. And now that duration play is starting to work. If you were early, 12 months early, it hurt an awful lot. But now as that starts to become a more realistic long-term target at that 4 to 5 level, 4 to 5 sounds terrible on the 10s.